Wednesday, December 21st here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sazi. And let's get right to the top three things you need to know as the clock hits 9 a.m. Futures are in the green on this Wednesday morning after earnings reports from two major companies raised some investor hopes that things might be better than feared, even with a possible recession looming.
Just do it. Nike shares are rallying this morning after the company easily topped expectations and raised its outlook. We've got the breakdown on that report and why Wall Street is really optimistic about it.
And FedEx announced new cost-cutting plans for its operations after another quarter of weak demand for packages. We'll bring you the analysis you need to know. But we have to begin today with our top story, which Brad just mentioned, the monster quarter from Nike. Nike stock is surging this morning after the retail giant posted better than expected earnings and revenue in its most recent quarter, quieting investor concerns that the company would be hammered by weak economic growth. Couple things at play here, guys. First, liked on that earnings call last night that Nike execs hopped on this call and they said not only were sales strong during November when Black Friday kicked off, but also some of those strong demand trends continued into December online in stores. We have not heard that from many retailers. Nike is out here calling it out. Number two, and I have a story on this on the Yahoo Finance homepage, finally, inventory has started to come off its peak here at this company and looks like it's set to continue to improve. Nike calling that out on its earnings call last night. Analysts have really liked that.
Yeah, there were three things that I really took away from this, and you mentioned one of them, which is that inventory bounce back. I also really nodded to the basketball category here within this, and then additionally just the return buyers, and breaking down just two of those, if I may. One of them with regard to the basketball segment, they saw double-digit growth, and that was really one of the catalysts for this most recent quarter as well. They also talked about the repeat buyers that they saw over the course of the quarter on the earnings call, and really what that contributes to the direct segment. The direct segment grew 23%. Digital was up 31% as well year over year on double-digit growth in traffic and repeat member buying there.
Yeah, what's interesting, too, is that where Nike was selling its merchandise, right? The company has been, for the past few years, really trying to pivot more to that direct selling channel that you were talking about with its quote-unquote members. I think that just means people who have logins on the Nike.com site. I'm one of them, full disclosure, but I guess that's what they mean. It's not like you pay to be a member. You just sign up. Anyway, the point is they have been pivoting to that over the past few years. But this past quarter, they sold quite a lot of merchandise through the other channels that they've been sort of snubbing over the past few years or migrating away from, those wholesale channels. So that's been an interesting phenomenon. I don't know if that's something that's going to last or it just was kind of a way to clear out the inventory, but it is an interesting phenomenon, that sort of shift.
Yeah, they did talk about that. They highlighted, or they called out off-price channels. So on that earnings call last night, so of course, anytime you hear off-price, you're thinking about Burlington, you're thinking about TJ Maxx, you're thinking about Marshalls. I would keep an eye on those stocks this morning as well. Also, we want to keep an eye on a company like an Under Armour, Adidas, those stocks catching bids in the pre-market off of this Nike quarter. And perhaps maybe the retail apparel industry is past the worst in terms of inventory growth. Nike's inventory still up 43% year over year. They have a couple more quarters to get things right, but again, it is moving in the right direction.
Yeah, they said regarding inventory, they believe the peak is behind us as actions we're taking in the marketplace are working. And then to your point on wholesale revenue, that grew 37%. They cited strong marketplace partner demand. But when have we ever seen an athletic or a footwear and apparel company literally have customers who set up bots to buy their merchandise, to buy some of the most coveted SKUs or items that are on their website? Nike has that, and so that's where you lean into some of those repeat buyers. Of course, you have a restocking fee, and they've been battling up against some of those bots, but it really goes to show some of the strength of the brand itself, and then additionally, where they're able to move towards or through some of the inventory headwinds that they had been on a more accelerated basis, perhaps than some of the other competitors in the field.
All right, and Julie, you mentioned members, and I think that's a number the street tried to probe Nike execs a little more on. They highlighted they have 160 members.
160,000?
160 million. 160 million.
Okay.
It is unclear what those members are. They're not paying a subscription fee, but
they're just people who buy stuff from them.
People buy stuff, so they recoined it members.
Them,
but you have to wonder, is that a missed opportunity? Do they have an opportunity to do something like Costco and a BJ's and create some type of subscription model? And that is a lot of people on the site. That's a ton of people.
I think the free nature of it has certainly attracted a lot of people, and they already know that they're going to make their money on making sure that people have kind of a shock and awe. They've done that through shock drops to make sure that some of those members feel like they're getting access to something else before the rest of the people who don't have memberships have. So the access in itself and how they've been able to tease out certain drops versus other kind of items that may make their way into some of the TJ Maxx's or the Nordstrom racks or whatever of the world. I think that's where they've kind of really drummed up the value of that membership too.
I think they used to have, and I don't know if this still exists, a subscription shoe service for kids. Because as a parent, you know that your kids' feet grow quickly, so you're spending all this money on a shoe that you know you're going to have to replace in 6 months or a year. So that to me makes sense. There used to be a program called Easy Kicks, which I think Nike had a relationship with. Anyway, that to me seems like it's an interesting area to plumb as well.
Also China too, real red flag, week across the board, not good.
Absolutely. Well, another major earnings announcement that we have been tracking as well, FedEx stock, that is on the move, up by about 6% right now, actually, this morning after the company posted mixed earnings in its latest quarter and said that it will cut another $1 billion more than what it had forecasted in September as weak demand impacts its quarterly profit, and specifically on some of those cuts, it's cost cuts that they're really moving forward with. But segment by segment, it wasn't really a blowout here. FedEx Express operating income, that declined 64% year over year, lower global volumes. They had signaled that at the end of last quarter. And then going forward from here, it seems like, based on what they said on the earnings call, there's going to be significant kind of cost reductions that they're going to be initiating. That's where that kind of $1 billion comes into play. It's actually $3.7 billion in total discrete cost reductions relative to their plans.
Yeah, what a different story. We have Nike here telling you demand looked to be pretty solid overall coming through December, and you have here FedEx really telling you the opposite. That Express segment, really both segments, but not good from a package volume and just an overall sales perspective. Earnings call, I would say, wasn't that great as well. They're exactly acknowledging they have a lot more work to do in the Express segment to take out costs and improve margins. But this stock move, of course, is not reflective of the package volume trends. This is a stock trading now off how much cost FedEx can take out of its business. And at some point, FedEx is going to have to pay the piper here. They're going to actually have to show these cost cuts to the street. They didn't really show them in this quarter, I would argue, but they're going to need to show them in the coming quarters.
I mean, and I know that UPS has been doing better than FedEx on a relative basis, but you do have to acknowledge that the environment is pretty tough here. So they're trying to make this transformation in what is a difficult environment, because you do have the post-pandemic payback, if you will, where we're just naturally going to see a decline, and a decline in both, I think, on the corporate and on the consumer front, the willingness of people to pay up to get stuff more quickly, right? Because people are just more cost sensitive right now than they had been. So, it's a tough time to be making those changes.
You have to wonder, are they starting to take out too many costs where they may not be able to deliver that package? And here's a fact that I didn't even realize. Year to date, they've reduced 8 international routes and 32 U.S. domestic routes while parking 5 additional aircraft. That's within the Express segment. More efforts like that seem to be on the way. So are you at the point now where FedEx is just going to lose business to UPS? Yeah,
they mentioned a large portion of the savings coming from those reduced flight frequencies that you were mentioning. But some of the things that they're not going to be able to get around are things that they cited within this, and that is higher fuel surcharges, some of the base rates, the exchange rate impacts. So those are variables that are out of their control. And so with those uncontrolled variables, you would hope that by this time next year, if we did see a continued reduction or at least a movement lower in some of those fuel surcharges that they have to take on, that maybe there's some alleviation of the pricing pressure that has to get passed through to consumers, or at least the upfront costs that they have to incur themselves.
It costs more to get your Heritage Flakes, Julie. Much more.
No, I just go to the store and
just go to
TJ's and get my Heritage Flakes.
Okay.
There's no package. Well, unless they're passing on the cost of shipping to me, but I don't know if they use FedEx.
There's no subscription
at
as a
Trader
service for Heritage Flakes? There needs to be.
Not
It's on Amazon, but you don't belong. So you can't even get Heritage.
I wouldn't know.
Flakes.
All right, let's talk about our last story that we're focusing on here at the top of the show today. Twitter CEO Elon Musk confirming in a tweet last night that he will in fact abide by the results of his poll over the weekend and step down as head of Twitter. He added this will only happen once he finds the right successor. I mean, okay, yeah.
Congrats, Brad. Looking forward to following your tenureship at Twitter.
I mean, this.
A lot of big changes that got planned.
This stuff, as I said yesterday, he has made clear pretty much from the beginning that he did not want to run the business permanently. That said, he said even when he finds somebody to run it, he'll still be in charge of the sort of software and server operations. So that's going on. Clearly, there's been the problem of alienating advertisers. That's not something he does well. I think it's pretty clear. So maybe he's been looking for somebody to do that, and some of the folks that he has been turning to for advice on Twitter have been sort of lobbying for the job. Jason Calacanis is one of them. David Sachs, who was at PayPal, is one of them.
I do think Joe Lonsdale worked with Elon, I believe, back at PayPal. He was floated. I reached out to him this morning. He did not get back to me for comment on whether Elon floated that job by him. But look, clearly it's going to be an Elon supporter that's taking this job. And then even so, they're still going to have to deal with Elon. The view that he's going to just focus on software and various updates is absurd.
Well, it comes at a time where the board of directors over at Tesla is also under fire, because at a time where the stock is hitting some of the 52-week lows that we've been seeing, the Tesla shareholders are upset. And they're now going directly to the board of directors, some of the shareholders that actually hold the most shares in Tesla, to be able to have that kind of say. But even more of the pressure on the board of directors to make a change over at Tesla. But then at the same time, you've got some of the different analyst notes that are starting to pour in too. There was one from Evercore Tuesday, Mizuho. They also
They're starting to revolt.
Yeah.
The street's trying to revolt against Tesla. That stock down 8% yesterday, up a little here in the pre-market. But the analysts are starting to pile on.
Well, and it's not just analysts, it's what's actually happening at Tesla. There's a new report this morning from Electric that there is a new hiring freeze at the company. Now, the company had initiated a hiring freeze earlier in the year, then started hiring people again. So this would be a new freeze. And Electric is also saying that on top of the freeze, Tesla said teams will be expected to make layoffs during the first quarter of 2023. Now, Musk was out on Twitter yesterday saying, you know, this is sort of economics 101 or 101. He made some sort of
blame shifting,
skeptical comment in response to a comment from Ross Gerber, who was on our air earlier this week, that, interest rates are, he basically blamed the Fed, is the bottom line here. He said it's the Fed's fault. They're raising rates. They shouldn't be raising rates. Clearly, two things in response to that. One, whether they should be or they shouldn't be, they are, and that's the reality he has to deal with. And secondly, there are obviously other factors in play. You can't just blame the Fed. Right. The economy is slowing. There's more competition within the electric vehicle space. The business in China is troubled. That's the reality of things on the ground, and he's spending a lot of time on Twitter.
Am I allowed to like that tweet? I don't know, it's just funny. I like that one. Everything he posts, I mean, a lot of it is absurd, but I don't know.
Well, but it's
go get your textbook.
It's dunking when you're running a big company that a lot of people are invested in, and you seem to be treating it as a joke.
But yeah, the dunking is really just him continuing to clout chase, whether you're going to, some high-profile event and trying to get on stage with Dave Chappelle, or whether you're trying to dunk on one of the analysts out there that covers your company. It still shows that the priority is not in turning things around, even at Twitter, or making sure that your priority is just giving that fiduciary responsibility to the shareholders who have demanded it over at Tesla.
The other thing, there was a quote, I think it was in one of the Bloomberg stories about this morning, that said, he has turned the service from a reflection of the news of the day into the main topic. I don't want to be talking about Twitter. I want to use Twitter as a service for which it's intended. Mm-hmm. It's just changed the whole discourse.
We're stuck with the guy. Even when he eventually even unloaded in a decade, his name is forever going to be tied to Twitter. Yeah. He's going to be involved in some way. It just is.
It's true.
It just is.
That's fact. Guys, coming up, our next guest says recession indicators are rising. So where should you put your money? That's the big question. We're going to discuss that next. As the Fed continues their fight against inflation, it's likely that getting a handle on it would mean the unemployment rate rising, creating some stagflation. And for more on that and a look around the markets, we welcome in Emily Hill, Bowersock Capital Partners, CEO and founding partner. Great to have you here with us, and a happy holiday season to you as well, Emily. When you look out to the next year and some of the top things that investors should be keeping an eye on as they manage through this environment with their portfolio, what are those top three things in your mind?
Well, I'm encouraging people to keep in mind that there's still a massive amount of liquidity in the economy. And I think one of the Fed's challenges is that every time it even hints at optimism or hints at a future pivot or pause, we see financial conditions loosening. And my general advice is to accept the fact that this normalization process is going to be lengthy. So I don't think we've got a solution coming in the next quarter. I think that I do expect a recession. I have no idea how deep that recession will be, but I think we're probably in for a bumpy ride for 2023. So patience is what I would counsel.
Emily, it's Julie here. So, I think investors are still sort of shell-shocked over the past few years, right? We had a pandemic. We have now the Fed raising rates. What are the sort of fundamental takeaways of how investors need to adjust their paradigm right now and how they're thinking about investing, especially if this rocky period is going to last a while?
Mm-hmm. I don't think we're going back to a period of easy returns. We've had years and years of loose financial conditions that have generated something of a bubble. So you look at U.S. stocks now, and yes, they're probably fairly valued, but they're still not cheap. And, one of the underappreciated dynamics globally is climate change and the just increasing pace and frequency of geopolitical shocks. And I don't think market prices are taking that into account. Those supply chain shocks are inflationary. So I think it's even more important than it was 2 years ago to have a very diversified portfolio that includes both public and private investments, and that's prepared for numerous different scenarios, including a global recession, including stagflation, and including more of what we've had in the last year that could go on longer than expected.
Emily, if the last 5 years for investors could be seen as a Goldilocks era, low rates, tech stocks seemingly going up every single day, what do you think the next 5 years will be defined by?
I think the next 5 years are likely to be a bit of a slog. And also we are going to continue to see the same types of geopolitical shocks that we've seen in the last year and a half. It's just been, think about the Russian invasion of Ukraine, all of the turmoil in China. We are really seeing a global shift that you're right to call it a Goldilocks economy, but we're seeing a shift from an era of globalization, which really kept a lid on inflation, to, I think, a much more tumultuous 10-year period that, again, I think people are not recognizing the cost to the global economy of climate change.
So what is the top area that you're suggesting when people reach out for advice and are looking for guidance right now?
Mm-hmm. We really like private global infrastructure. So anything that will benefit from a waning or an increasing demand for limited resources. Number two, for more risk-averse investors, we like bonds. T-bills, June T-bills yielding over 4.5%. We haven't seen that for years and years. The risk there is that you get to June and you need to, buy new T-bills and suddenly rates are lower. I think that's very unlikely to happen. We like investment-grade corporate bonds for more conservative investors.
Well, looks think we lost Emily there as well. We'll note she is bullish on Costco here as a stagflation play. That was Bowersock Capital Partners CEO and founding partner Emily Hill. All right, coming up, no fun at Six Flags as the struggling ride land secures a new activist investor. More on all this next. Hey, welcome back. The opening bell on Wall Street is just a few moments away, so let's hit a few hot Yahoo Finance trending tickers. We continue to track Six Flags. On news, activist investor Jonathan Litt has taken a stake in the struggling theme park operator. And you want to get me excited? Send over to me a presentation from an activist investor on a new target. I love these things, and I like what Jonathan put together here, saying Six Flags, its share price should double just based on the real estate it owns. And I encourage everyone to, if they want to understand the situation better, go to the Six Flags annual report, keyword real estate, and you can see some of the giant real estate holdings this company owns that it might be able to monetize and maybe spin off to another holding company.
I mean, this is straight from Land and Buildings playbook. This is Jonathan Litt's firm. It's called Land and Buildings, and this is something he has done at a number of different companies where he goes to them and he says, listen, you own all this real estate, but you're not fully taking advantage of it. You need to spin it off into a real estate investment trust and do a sale lease back where you then lease the property back so you can properly take advantage of it. So that's pretty much what he is saying in this case. He said that he has recently met with the management of the company, including the CEO, Salim Basul, who took the helm at Six Flags in 2021. And so it seems like that he believes they are going to be considering this, and that seems to be also one of the reasons that the stock is up.
Yeah, and he believes that the real estate alone is probably worth about 1.7 billion, well, worth more than the current market cap, and that is roughly or about 1.7 billion dollars, and we'll see how that moves around once trading opens up officially. But again, I mean, 27 theme parks, water parks that we're thinking about with Six Flags. If it was able to at least look across some of the underperforming theme parks that it does have to say, all right, maybe it's a viable step forward at least to experiment and say, all right, we'll realize at least some cash appreciation and then be able to just lease that back, as you were mentioning, Julie, to ourselves to operate on in the future as well.
But this has been really a terribly run company under the new CEO. He started in November 2021, just passed his one-year mark. Of course, he had that flub over the summer regarding people who he thought were visiting the parks because they cut the prices so much. But see the stock price there, really under pressure all year. Not a lot of pricing power in a very competitive environment.
It was terrible last quarter.
Terrible.
I mean, what? It was down total attendance by about 33% from a year earlier. And this is at the same time where we had a lot of the golden age of travel that was being talked about and the parks and resorts continuing to reopen in full force. And that compared to a year where they were still having to implement some of their pandemic era or vaccination requirements. And so even with all of that in mind, Six Flags has underperformed tremendously and in a key quarter where people were outside during the summer. And so that should have been a red flag in itself.
I wonder how Six Flags does over the next decade if we're all wearing AR glasses. Do we even need to go to a theme park? Can we get the same thrill in our glasses?
You could go to Dave & Buster's and have the same experience as a Six Flags theme park without.
No, I don't agree.
They had some of those rides, some of the virtual reality rides.
It's not the same.
Not the same.
It's really not the same. No,
I'm all about viewer feedback. So hit us up. If you you think that's a better option than going to Six Flags, let us know. Maybe,
riding an actual roller coaster and doing it unless.
Are you on Team Saz or Team Julie? Give us
I'm just
the
afraid
hashtag.
of the roller coasters, perhaps.
Really?
Maybe that's me. Yeah.
I'm afraid of roller coasters too, but having done both virtual and real, there's nothing you're not getting the wind.
You could blow some wind at me.
I just want to hear you explain this. This is great. I like watching this. This is fun.
I
wish I was home so I could watch
I have
this.
a son who loves roller coasters, and he likes the virtual stuff, but one is not a replacement for the other.
So if you're
in
at the
my view.
water park on Six Flags on the AR goggles and they shoot water at you, it's not the same.
Oh, come on. A water slide is not going to be replaced by AR or VR or
that
any
won't,
kind of,
no. Yeah.
just RR.
Just learning more about your views, Julie.
Okay, sorry.
Let's talk about Rite Aid, too. I don't think they have any amusement rides there, but it has been quite a ride for Rite Aid. It's up by about 2.5% here pre-market, following an earnings report in which the company posted narrower than expected losses. They beat on expectations on both the top and bottom lines. The drugstore giant reported that same-store prescription sales grew 4.4% year over year for the third quarter. There you're taking a look at some of the actuals versus the estimates on your screen here. And then additionally noteworthy that the company had said that they lowered their guidance due to headwinds, including pharmacy margins, seasonal markdowns, and higher shrink.
Well, hello, flu season impact. And we were talking about this, I think, yesterday with Anjali about CVS and Walgreens. Big quarter for same-store sales at Rite Aid, up 7.5%, mostly driven by sales in the pharmacy, and also a 2.2% increase in front-end sales. So what is that? Essentially, people getting their prescriptions, and before they leave, maybe they buy a thing of Gatorade or a candy bar and go home.
Yeah, but it is interesting if you look at the pharmacy companies versus one another. Rite Aid is sort of just not in the same league.
Not fun
I
to
think.
shop at Rite Aid.
Well, but I was going to say also just in terms of CVS is obviously much more robust or full suite of healthcare services at this point. Walgreens sort of leaning that direction, but Rite Aid is not.
Yeah, I mean, I went into
there.
Rite Aid over the weekend. I was looking for some new eye retinol. They didn't have my brand. I went right next to Target next door. I got my retinol, Julie. It was great.
Got to email the company about that.
I will.
It was down in some of the key categories, and there are really two key categories for this business. It is the pharmacy segment, and then, of course, on the other side, so there's the retail pharmacy segment, and then the pharmacy services segment as well. But pharmacy services was down year over year, and then additionally here, you saw the retail pharmacy segment down as well year over year too.
We know a lot more about Brian Sozzi's beauty regimen
bits
than
and
I
pieces,
always
bits and
thought,
pieces, that's it.
than I ever thought that he would
Take up at his desk.
Give a little taste
need
of
to know. The retinol. There's the opening bell on Wall Street. United Rentals is ringing the bell here this morning as we talk about transportation and logistics this morning. They listed 25 years ago, so that's what they're marking today. As we take a look at what's going on with stocks to get out of the gate here this morning, we've been looking for indications of a higher open. Obviously, it's a holiday week. We have to note that. The volume tends to start to fall off into the end of the year. You also sometimes see some weird moves as people are doing some tax loss selling or whatever have you, moving things around in their portfolios towards the end of the year. So maybe we're seeing a little bit of that as we get into the end of the year. Shrug, say me and Brian Sozzi, but you are seeing stocks rally today. And we did have a couple of more positive earnings movers that seem to be helping things. Brad, what are you seeing over at the Interactive?
Yeah, get the green party hats on, at least for right now. Dow Jones Industrial Average right now is higher by about 0.9% out of the gate on the day. Let's take a 3-day look at this here. On this hump day, we're up by about 0.7% over the course of the week. But a lot of those gains really just coming from today. We've also got the Nasdaq Composite that's higher by a little more than 0.5%. S&P 500, you're also seeing that to the upside right now, and we'll see which sector that's led by in a hot second, but that's up by about 0.7%. Still flat, just barely to the downside over the course of the 3-day period for this week. And so let's take a look at some of those sectors and what's taking place here today. Well, look, every sector is in positive territory as of right now, but which one is doing better? It's XLE, yeah, 1.7%. Exciting, right? XLY, though, that's up by about 1.4%. Consumer discretionary seeing a little bit of a bounce back. Yesterday took an L, but today, hey, we bounced back. All right, XLY, that's up by about 1.4%. No doubt led by Nike there. And then additionally, taking a look at the Nasdaq 100. We've got Apple in positive territory. That's up by about 1%. Amazon also seeing some gains. It's in the positive gains party by about 0.7%. Nvidia, ASML as well. We don't talk about that one too often, but ASML Holdings, you're seeing that with some solid green on the day. However, Microsoft, Google, they are in negative territory to begin the activity on this Wednesday. Julie?
Thank you so much. Let's talk about another tech company right now. We're talking about Workday. Shares there in focus following an executive shakeup. The company announcing that Chano Fernandez has stepped down as co-CEO and Carl Eschenbach has been appointed to the position effective immediately. This does set up a transition now for Eschenbach to become sole CEO after Anil Bhusri steps down from the post to become executive chairman in January of 2024. So just sort of moving things around. It's a big runway here, obviously, for that transition now to happen.
Yeah, I love this line by a friend of the show, Brent Thill, on this Workday. He says, quote, "We believe he will drive up," that is Carl, "drive up intensity up to another level at Workday." Big fan of high-achieving executives. Love that shout out by Brent.
Yeah, and the software segment, of course, big fans of co-CEOs, and that's exactly what we got here on the day. We got a transition of co-CEOs once again here. Of course, Salesforce was one of the most recent ones, and then we've noted the longtime co-CEO strategy over at SAP, over at Oracle as well for some time prior to Mark Hurd's passing. But again, here for the company in Workday, this, as Carl has worked closely in line with the company for an extended period of time, and Sequoia has had a relationship with Workday as well. And so within all of that, it'll be interesting to see what kind of direction he wants to see Workday in from this point going forward.
Yeah, maybe he can bring that intensity, just clean up the interface a little bit, just make it easier. It's tough. We've talked about it a couple weeks ago. It's tough. There's got to be a better way.
There are few SaaS interfaces that are pleasurable.
Yeah.
I can't think
I'm with
of
you, Julie. We'll agree on that one.
any
I'm with you.
really. But we'll see. I mean, Eschenbach was at VMware before joining Sequoia Capital. So obviously he has a lot of experience in this area. So we'll see what happens. It seems like, despite the stock going down here, it seems like analysts are fairly positive on the appointment. The company, by the way, also reaffirmed its forecast. Maybe that's responsible for a little bit of the hit to the shares. Unclear there what's going on.
Absolutely. Well, coming up on the other side of this short break, we've got more on the business of swoosh. Nike sprinted past Wall Street's expectations in its second quarter. We're going to break down the results with two analysts. That's coming up next. We're watching shares of Nike today. They are higher, almost 15% after the company lifted its guidance and found success using promotions to sift through its high inventory, helping to reduce its gross margins. Bernstein's senior analyst Anisha Sherman and BMO managing director Simeon Siegel join us now. Great to have you both here with us. Simeon and Anisha, perfectly kind of indicative of this broader kind of retail segment is some of the issues that we've seen on the inventory side. If there's anything, Anisha, that you take away from this report and look across the broader retail sector to signal that some of the inventory concerns may be starting to abate, if what's true for Nike, is that true for the rest of the industry too, or is it different?
Hi, Brad. No, I mean, I would say the opposite. I think, Nike's inventory is still year over year up 43%. It's slightly better than last quarter's 44%, but it's going to be a slow journey to get that number down. And this is despite heavy promotions. We track promotions on a weekly basis. They've been higher than they have been for the last year and a half, into Black Friday, et cetera. We saw factory stores promoting a ton of new product, mostly apparel, but the inventory number still didn't come down as much as they should have, as much as it could have. We're seeing the trend broadly across the sector. If you look at kind of Lululemon, VF, Deckers, I mean, we're seeing some big inventory numbers. So if a brand like Nike can't clear inventory rapidly, I think what it means for the sector is we'll see another few quarters of heavy inventories into sort of mid to late 2023 before we see any kind of normalization.
And Simeon, I've been interested about where Nike was selling, where it was working down that inventory, right? The direct channel versus the wholesale channel, and what we can expect there going forward. What did you observe on that front?
Yeah, it's so fun, Julie, because like you and I have talked about this forever. Whether I was just hearing what I wanted to hear or not, they talked about wholesale much more than they've talked about wholesale in the past. And so this notion of D2C is not all it's cracked up to be that you and I have run through. I think we're seeing a return to wholesale, which, by the way, I think most people are trained to think is bad. I think is great. I think we know that wholesale is a healthy channel. And so I think to Anisha's point, what's so fascinating about this, and it echoes the fun times we've had about the Lululemon belt bag, it looks like they did not clear through a lot of inventory, and yet their revenues were through the roof. And so this notion of it, we'll find out later what the North America inventory looks like. On the call, the company talked about having units down mid-teens in apparel through sequentially. So they are selling something. But what's just so interesting is in this world where we're seeing top line pressures, Nike, despite not working down that inventory, is seeing a huge revenue growth number. And that probably was boosted by the wholesale.
Anisha, Nike talked a lot about this last night on the call, 160 million members. How do you read that, and how is that, I guess, audience impacting this business?
Yeah, I mean, I'm actually very bullish on their prospects for DTC and particularly digital. We did see wholesale rebound this year, but I think it was partly lapping a very weak wholesale quarter last quarter. But I think what makes me bullish about Nike over the medium term is the fact that this is the biggest, most scaled up brand, and this is the brand that's in best position to grow its own customer base. And they've been doing that. If you look at the numbers through COVID, they've actually accelerated, not just grown, but grown at a faster pace than they were pre-COVID. They are making a heavy push for people to sign up to the app, the main app, the sneakers app, the training app. And so they get this portfolio of apps and a way to segment the product across their customer base, to personalize it a little bit more. And they've invested a lot in data analytics to be able to do that. So I think that points to the future wave of growth that we'll see over the medium term, which isn't just going to come from cranking out volume in mass. It's going to come from more personalization and targeting. And the way you do that is by growing your customer base and learning more about them. So I'm quite optimistic about that data point.
Simeon, we had a conversation with a guest towards the end of the summer who talked about, or at least forecasted, a sneaker super cycle. Is the results here indicative of a sneaker super cycle? And even if so, what does that mean for not just Nike, but for the rest of the industry? And could that kind of wither in the face of a recession?
But first say sneaker super cycle 10 times fast before you answer us, Simeon.
Sneaker super cycle, Simeon Siegel. We love our S's. Listen, they added $1 billion to footwear in North America year over year this quarter. That is a lot. And to Anisha's point, that is a lot for a company that is already so large. So I think what we need to internalize, I don't know what a sneaker super cycle looks like, and nor do I know what the tongue twister will sound like, but they are showing us. And this conversation, and I feel like when Sazi talks about members, I feel like I want to see what's on his shoes, what's on his feet right now, because we're all Nike members, right? And whether we've given them our name or not, we are Nike members. And so I run through, someone I was talking to, an investor today, who said to me, Nike has more members than Costco. And I said, yeah, but Costco members pay for that, right? And so I'm a little bit more focused on the revenue opportunity. I'm more focused on watching what they're actually putting up than thinking through what that really means, because when you are Nike size, you better be speaking to everyone in the world, and they kind of are. And that was what was so interesting when you look at the footwear versus apparel here and in China, because I'm sure we'll get to China, but I thought the disparity where supposedly they're losing all this share in China footwear, apparel was down. China footwear was up, I think, 21% constant currency. It was a big number. So I think whether we are in a sneaker super cycle is driven by Nike's performance. When you're that size, Nike's performance is suggesting we are in whatever that strength is.
Sneaker super cycle, maybe. All right, guys, you guys are gonna hang out because we are gonna continue this discussion in just a moment with Anisha Sherman and Simeon Siegel, and get their hot takes on the year ahead for retail, not just for Nike, but for the sector overall. We'll be right back. Retailers are zeroing in on the holidays as shoppers gather up last-minute gifts. But how will supply chain disruptions and heightened inventory impact this space as we get into 2023? Bernstein senior analyst Anisha Sherman and BMO managing director Simeon Siegel are back with us right now. Anisha, we talked to you at the end of November, and it seemed like you thought we still had a little bit to go in this promotional inventory cycle. Now that we've got a little bit more data under our belts, what's your thinking on when retailers really start to move past this period?
I continue to believe that. And I think the data points that we've seen over the last month have shown that, because inventory levels have not normalized yet. They're still incredibly high. They're coming down sequentially, but they're nowhere near kind of normal levels as percent of sales. Nike, for example, pre-COVID was running at about 15% of sales. They're in the high teens to low 20s right now. I think they will probably end the year in kind of the mid to high teens at best. It will be hard for them to get into that 15% range until next FY. And that's one of the strongest brands out there, right? So if Nike is struggling to clear inventory, then when you think about the tier 2, tier 3 brands out there, it's going to be a heavy inventory first half. I think where that benefits is for some of the clearance retailers, like the off-pricers, because they're able to scoop up that inventory for much cheaper and resell it. And that environment is not going away anytime soon, I think.
Simeon, if inventory levels are starting to improve, costs are starting to come down just a little bit, what do you think what is their biggest challenge next year?
So it's interesting. I think that retail's tough business, right? Brian, you and I have talked about this for years, where they have to focus on forecasting demand, which is hard enough. The last 2 years, they had to forecast supply. That goes away. Forecasting supply is now easily. I mean, you can do that. You know what you're going to get when you're going to get it, all things considered. So we're back to, how do you run a business? How do you forecast demand? And I think that's this replenishment versus recession conversation that you and I have been having, where at the end of the day, did people overbuy things, or did people, are they not spending now because they can't, or are they not spending now because they don't want to? And that's where I think, to take Anisha's point, I think that on the one hand, you have the TJXs of the world that will benefit because of excess inventory. On the other hand, you have the Capris of the world, which will benefit in spite of it. There are certain companies out there that are saying, I don't need to promote. I gained brand elevation during the pandemic. I may as well keep it. I spent 15 years losing pricing power since the 2008 recession. I got it back in 2020. I think the brands that can focus on maintaining that pricing power are the brands that are going to walk out healthier in 23.
Who are the brands that are best positioned to outperform, Anisha, in that environment where forecasting is difficult because you're coming off of some tough comps, and then additionally trying to make sure that you're working through inventory that still is out there and going to be pushed out perhaps to some wholesale partners as well?
Yeah, I think some of the factors that we look at are seasonality of the product. So if you're, in the footwear business, that's a less seasonal product than trending fashion apparel. If you're in, Simeon talked about Capri, if you're in the handbag business, that's a less seasonal product line. Fashion apparel is more seasonal and therefore more subject to issues with not just supply, but also demand. If you can't sell it in the winter, people aren't going to buy it in the spring because you need a fresh line of products in. So seasonality is a big factor. Lead times are a big factor. So if you've got kind of 9 to 12 month lead times, like some of the more traditional brands or department stores do, it's harder to predict demand. If you have lead times that are shorter, Inditex has lead times of kind of 4 to 6 weeks. You're able to turn on a dime much faster as demand changes. So that's another factor. And then value versus premium. And I think value has taken a beating this year as pent-up demand has fueled spending in the first half. But value is going to start to gain some more share and get back the share that they've donated as people are a little bit more cautious now going into 2023 and lapping the strong growth of 22. So those are some of the dimensions that I think will determine the winners.
And of course, Simeon, can't let you go without some form of take on Peloton. It really has been your big time post-COVID call here the past year and a half. Where does that brand shake out next year?
I forgot to show you my latest water bottle, Brian. There you go. Did that for you. Listen, I think that Peloton is probably the most emblematic story that represents everything we were just talking about. They saw their business collapse. They saw their business surge. They built it as if it would last forever, and then it came back down. That is retail in the pandemic. Peloton is just the largest version. And I think when thinking about companies that took these results and assumed they would last forever, the question we have to ask is, did they over inventory or did they over infrastructure? Unfortunately, Peloton did both. So I think right now, I think the new management is doing an excellent job at removing the fixed costs. I think they've been allowing themselves, their default risk has been removed effectively, but that doesn't mean they're a grower. And so I think we're going to go back to this story of what happens with churn now that we're walking through the remainder of the pandemic, now that the average age of a Peloton subscription is no longer a year because you're not doubling up your subscriber base every year. And so I think bottom line, they're cleaning up the business very nicely. They can get to that cash flow break-even level pretty easily because it's under their control, but it does not mean they have this limitless TAM. It doesn't mean they can find more people to buy the bikes as people continue to cancel them. And so for that, I think where we are right now, I'd be more concerned. Still think the product is excellent, but worry that from a stock perspective, it's inflated.
Well, thanks for hanging out with us this morning. Bernstein Senior Analyst Anisha Sherman and BMO Managing Director Simeon Siegel. Have a great rest of the holiday season. Appreciate it. All right, if you love the thrill chasing meme stocks, the chances are high it has been a tough year for your portfolio. Here are a few numbers. The Roundhill Meme ETF, ticker symbol meme, has crashed 62% so far this year. Spurring that decline has been sizable losses in the ETF's top 5 holdings: Rivian, Robinhood, Snap, Coinbase, and AMC. These 5 stocks have shed on average 76% year to date. Straight ahead, McDonald's could beef up your portfolio if there is a recession in 2023, while Starbucks could lose some steam. We'll have takes on all this next.
Jefferies analyst Andy Barish is picking his winners and losers in the food space going into 2023. He downgraded Starbucks this morning, warning of recession risks, but picked McDonald's as a favorite going into the new year. The food and drink space is where we find Sazi's take today. Let's start with Mickey D.
Yeah, a lot of information to unpack here from Andy Barish. Really good note here. So Barish is bullish on McDonald's, one of his top picks for next year. So let's take through this. First, same-store sales really did well in the 2008-2009 recession. That is part of Barish's call here, that a company like McDonald's, there I am at McDonald's, hat on there, very, very cool, will do well in a recession as consumers trade down. Now, he's also saying that same-store sales really did well coming out of the 2008-2009 recession. So that is a good, perhaps if we enter a recession in the middle of next year and we come out of it in the latter part, that might benefit McDonald's, at least according to how the 2008-2009 recession handed down. And as I just mentioned, people trade down historically to McDonald's in tough economic times. Why? Because the food is still relatively cheap despite inflation. And here you can see that chart from Barish here going back, showing those sales outperforming, relatively speaking, the broader restaurant industry during that period of the 2008-2009 recession. McDonald's doing pretty well during the recession and coming out of the recession. Barish saying that through 2024, he thinks McDonald's brand relevancy led by value and convenience to support same-store sales and profitability outperformance versus peers. So McDonald's looking pretty good in a potential U.S. recession next year.
Okay, and so where is Barish?
Well, he's not too keen on Starbucks, putting out a lengthy, I would say, downgrade report on Starbucks. Really the opposite of the play on McDonald's here, that a recession could impact Starbucks in a big way as consumers trade down from that brand. Perhaps maybe they go over to a Dunkin' brand, or they just make their own coffee at home. And then, right, I know, right? Go figure. People making their own coffee at home instead of spending $12 in Starbucks. But also noting that the shares are a little bit pricey from a valuation level right now. Thinks recession will hurt the company's sales. Also, another analyst noting that, or just thinking that Starbucks set its expectations for its financials too high at its recent investor day. Now, on the positive side, a China reopening should benefit a company like Starbucks. It didn't really benefit a company like Nike in the most recent quarter, but still it might benefit from Starbucks next year. My take here to tie this all in a bow: in a recession, cheap burgers ultimately win. $8 coffees do not. And I think that fits or just jibes very well in what we've seen in past periods of recession. Consumers just cut these things out and look for cheaper alternatives.
All right, little luxuries in one way or another, perhaps. Value versus luxury. Guys, coming up, we're going to have some breaking news on the housing market and how consumers are viewing the economy next.
Welcome back to Yahoo Finance. I'm Brian Sazzi alongside Julie Hyman and Brad Smith. Markets are being lifted by better than expected earnings reports from Nike and FedEx last night. All three major indices right now in the green. Dow up more than 300 points. Julie, we are getting some breaking news, though, on the, I believe, housing and consumer confidence front.
Indeed. Let's do existing home sales first. They fell by 7.7% month over month in November to an annual pace of 4.09 million. That is worse than the 4.2 million that was estimated. We already know some of the headwinds facing the housing market, including, what's going on with the supply dynamics, as well as obviously what's happening with mortgage rates. We talked a little bit with the head of the NAHB yesterday about some of those issues. So again, existing home sales missing estimates. Consumer confidence coming in at 108.3, which is actually considerably better than estimated in December, and an acceleration from the revised 101.4 reading where that was the prior month. So interesting there that we are seeing an improvement in the consumer confidence numbers. I'm trying to click on into the release from the conference board, but having a little trouble here, I imagine.
Service temporarily
Yes.
unavailable.
So I assume that a lot of folks are having the same idea that we are. The present situation index is improving here. It looks like that's around 147. So that's part of the issue. But again, not seeing a lot of the details here. I'll continue to dig in and see
It looks to
if
be
we can get more info.
better than expected read from the conference board. Fits what we heard from Nike. Like we've been talking about all morning long, sales for them continue to be solid, if not, dare I say, strong into December.
Yeah, it looks like my page is refreshing right now, so I'm going to see if that fully goes through. Okay, so it did not. But anyway, continuing to also look through the housing data that you mentioned a moment ago there, I was just taking a look at one of the reactions on Redfin stock. Redfin stock has been holding on to gains for much of the morning here, still up by about 2.5%, but did pair some of those gains to the tune of about 3.2% on the back of that news that just dropped as well on the existing home side. But again, a lot of focus really on the consumer confidence reading and exactly where that's starting to be kind of parsed into sentiment, especially in the important holiday shopping season.
There has to be a better way. The conference board, they need to fix this site. Anyway.
Maybe I know a guy who might be stepping down as the head of a social media service who knows a lot about softwares and software and servers.
Oh, conference board
updates.
Give Elon a call. All right, let's give it to our friend Jared Blickery at the Big Board to see how the markets are taking all this economic data. Jared.
I'd say they're taking the economic data in stride here. We have the Dow up 1%, S&P 500 on its heels there, up about 0.9%. Nasdaq just behind the S&P, and the Russell really the outperformer of all the indices there, up just a little bit more, 1.11%. I want to focus on a little bit longer term. This is the S&P 500 over the last 6 months. Excuse me there. Excuse me, sorry about that. What's notable is that we just fell off breaking this trend line that we had in place for at least about 6 weeks here. We could be coming up to test some kind of breakdown level, and I'm thinking that's going to be about the 3,900 level. If we fail here, it's probably going to be down into that Santa Claus period. And for the record, the Santa Claus rally only takes place from the last 5 trading days of the year plus the first two of the next year. So actually it begins this Friday. So all the seasonality talk that we talk about, all of that leading up into it really hasn't even taken effect just yet. But as they say, so goes the Santa Claus rally, so goes January, so goes the rest of the year. We did have warnings last year around this time, and we did not see the Santa Claus rally really materialize, and then we saw that steep fall off in January. So whatever happens over the next few weeks is going to be pretty important to see what I guess as prescience to see what happens with the markets into the rest of the year. Now, S&P 500 leading sectors today, we have real estate, that's up 1.3%. So is financials, consumer discretionary. That's a Nike story that we have been talking about. Industrials, staples, all of those outperforming. So really a story about the consumer. And let's just take a look if on this green day we have any standout leaders. What's interesting, we have XRT, that is a retail ETF, as well as a regional bank ETF, as well as chip stocks. So chip stocks are those cyclical stocks that have really gotten hammered recently on this decline that we had in the first part of December. So it looks like the stocks just kind of treading water here over the last month. Be interesting to see. That could be a leading indicator to see if we get any kind of sustained breakout to the upside. So again, Santa Claus this Friday. That's when it officially starts, guys.
All right, green day amid a boulevard of broken dreams over the course of 2022 here, Jared. Thanks so much. All right, guys, switching gears, talking Elon Musk here. He's confirmed that he's going to step down from the helm of Twitter upon finding a new successor and shift his focus to the engineering side of the social media company. This comes after Musk posted a poll on Twitter where 57% of respondents voted for him to step down as the head of the company Twitter. Sinan Arnell, the hype machine author and David Austin professor of management at MIT, joins us now. Great to have you here with us today. First, when you just kind of look back on, of course, the very official poll, obviously that went forward over Twitter and the respondents, and ultimately what Twitter has looked like, the entire headache that surrounded it since he's taken over. What do you really look at and extrapolate from this? What are we going to be saying years from now about this?
So the last two times, thank you very much for having me. The last two times I was on with you guys, I predicted two things. First, that the deal would go through, and that that Elon would have an unbelievable difficulty running Twitter. I think I quipped that it's not as easy as colonizing Mars, and I think he found that out extremely fast. First was the content moderation decisions. He basically abandoned content moderation. You saw a lot of privacy, security, and safety staff flee or be fired. This created an unprecedented rise in hate speech and misinformation. On the heels of that, you saw advertisers fleeing Twitter. In the most recent weeks, you saw him banning journalists, first with no reason. Then he claimed for doxing him with the promotion of the Elon Jet account, either mentioning it or linking to it. Then those journalists were restored. He then set a policy that links to competitors like Mastodon and even other social media sites would be banned, which is clearly anti-competitive. Then he reversed that policy. And then at the end of all of this chaos, he put a poll up, and the overwhelming majority of 57% said, please step down. You are a complete disaster as CEO of Twitter. And it looks like he's going to do that. This is a great thing. He really had no idea what he was doing. He is obviously a great entrepreneur. He's got amazing track record at Tesla, SpaceX, and other companies. But this one proved too hard for him. And I think we'll all be happy to see a new CEO soon.
Well, but new CEO, Sinan, doesn't mean he's actually leaving the company, right? He's still good. And we've seen before that even when sort of personalities like him step aside, it doesn't mean they're really stepping aside. He said he's still going to run the software and server part of the business. I'm curious if Twitter's past the point of no return in terms of its identity as a social platform.
Well, two thoughts. Julie, great to see you. Certainly, he has a hard time letting go, and he has an even harder time staying out of the spotlight. He desperately wants to be talked about, and he desperately wants to talk about himself. It is strange to me to see such an investment, a leveraged investment into a company, and then to not have a fiduciary responsibility to have it run properly by somebody who would put the priorities of the company first. The second point in my mind is that, yes, we are seeing an unprecedented rise in the competitors to Twitter. Is it going to be the same? Is it going to be the town square? Or are people going to flee to Mastodon and Post and other types of alternatives? I think we'll see. We have seen an unprecedented rise in folks using Mastodon, using Post, especially Mastodon. We'll see whether Twitter remains the primary go-to source of town square conversation.
Sinan, if you were named CEO of Twitter today, what would be your first three moves?
It's funny that you say that, Brian, because in all confidence, I do know that my name has been put forward for that role. I doubt that I would take that role if it was offered to me. But I would do a couple of things. It's not to say that Elon didn't have some good ideas for Twitter. For example, I do think that they could, make more money if they had a subscription business, but they would have to do it well. They would have to do it such that it wouldn't result in a lack of access for those without means. But you could charge different tiered accounts that were institutional accounts or bigger accounts or business accounts. You could charge for the blue check mark, like $8 as he suggested, but you can't get rid of the verification step and have anyone who pays $8 be verified. That was a complete disaster. You need to maintain the verification. So what I would do is I would immediately investigate new revenue streams, including new advertising revenue streams, new subscription revenue streams. I would immediately reinvest in content moderation, verification, safety, security. I would make sure that our chief privacy officer, our chief security officer, our chief safety officers were in place, had teams that were intact. The content moderation policies were consistent, intact, and being enforced. That would be important to bringing advertisers back. And then I would get out of the way and stop making Twitter about myself. I would try to be a CEO that was running the company, not a CEO that was using the company as my own personal microphone.
Yeah, I don't know that there's much hope of that happening, Sinan. I do want to ask you about some of the competitors that have come up, right? There's Mastodon, there's Post, there's some others out there. Do any of them pose a real competitive threat to Twitter?
Not currently, but that can change very quickly. So as I described in my book, The Hype Machine, this economy runs on network effects, and network effects build on themselves. In other words, when you have unprecedented growth in a company like you saw with a Facebook, like you saw with Twitter and other companies, TikTok most recently, that success breeds additional success and builds on itself. And it's very difficult to dislodge a large company that has very strong network effects like these companies do. However, the other dark side of network effects is that if the public loses trust, these types of networks are what economists call tippy, which means that they could tip completely in the other direction, and you could see a fleeing away from companies. And we have seen exactly this between MySpace and Facebook back in the 2005, 2006 era. And we could see it again. It depends on the policies of the platform, and it depends on the forward-looking beliefs of the consumers about which platform is the best place to be and which one will be the winner eventually.
Sinan, while we have you here to broaden it out a little bit, as we look to 2023, what would be your sort of big single prediction about social media, any kind of prediction for next year?
Yeah. I think that my big prediction for the coming year with regard to tech and or social media is automation, automation, automation. And there I'm talking about ChatGPT. This was a revelation on the heels of many other such revelations in what are known as these sort of large language or large vision models that are based on deep learning. DALL-E, DALL-E 2, ChatGPT, all put out by OpenAI and other companies and consortia. What these models do is they statistically take in large amounts of data, and then they make inferences about how to answer questions or complete thoughts or to write paragraphs. And as I showed in my own Twitter thread, you can use ChatGPT to write speeches. You can use ChatGPT to mint cryptocurrencies. It even writes computer code. There have been many comments about how we can no longer tell what is actually written by a human and what is not. I've seen people say, at how soon will synthetic Netflix, where the scripts are written by computers, and then the deepfakes are deep-faked actors acting in the shows. When will those shows, those synthetic shows, be more compelling than real actors and real writers? It poses very disruptive challenges for the economics of the content industry, whether it be writers, producers, editors, as well as the visual arts industry. We saw the Lensa app that was essentially using art by artists and then statistically creating new art from that raw material. What does that mean for the artist? What does it mean when automation hits speech, hits texts, hits visual, and the rise of synthetic content? That is going to be the story of 2023 in my mind.
Sounds like a fun and interesting world. Sinan Aral, the Hype Machine author and David Austin Professor of Management at MIT. Good to see you. Have a great rest of the holiday season. All right, on this Nike earnings day, let's spotlight shares of Lululemon after that retailer's disappointing guidance a couple weeks ago. The Morgan Stanley retail team spent some time at Lulu's headquarters with management and still sees the stock as an outperformer. Said Morgan Stanley, the HQ visit reaffirmed our confidence in management's solid long-term strategy and the business's credible growth opportunities by geography, channel, and category. Coming up, YouTube may be getting some NFL games. Julie has the details and other top headlines next.
Let's get to some other headlines that we are watching this morning. Ukrainian President Volodymyr Zelensky set to meet with President Biden at the White House and to address a joint session of Congress this evening to ask for support to counter Russia's invasion. It's Zelensky's first trip abroad since Russia invaded Ukraine in February of this year, and the visit comes after U.S. lawmakers proposed a spending bill this week that includes an additional $44.9 billion in aid to help Ukraine. Former President Donald Trump paid $1.1 million in taxes during his first 3 years as president, but paid no taxes at all in 2020. That's according to tax data released by the House Ways and Means Committee. Trump and his wife Melania reported negative adjusted gross income from 2015 through 2017. And those are among the initial revelations after the committee won access to those records following a protracted battle that led to the Supreme Court. Meanwhile, the committee now says the Internal Revenue Service did not complete an audit of Trump's tax returns when he took office, even though such a practice is supposed to be mandatory. The IRS only began its audit, which, by the way, is still going on, the same day the Ways and Means Committee first requested Trump's records. And the National Football League is reportedly in advanced talks to give YouTube TV exclusive rights to NFL Sunday Ticket. That would allow fans to watch most Sunday afternoon games. All of this according to the Wall Street Journal. Details of the agreement have not yet been reported. The addition of Sunday Ticket would boost YouTube's streaming efforts as the company looks to broaden beyond advertising sales and into subscription revenue. The agreement could be reached as early as this afternoon. Saz?
FTX founder Sam Bankman-Fried is expected to return to a Bahamas court today to seek his transfer into U.S. custody, where he will face criminal charges connected to the collapse of the crypto exchange. Yahoo Finance legal correspondent Alexis Keenan has the details for us. Alexis.
Hi, Brian. So yes, you have Bloomberg and Reuters both reporting that Bankman-Fried already signed surrender documents on Tuesday, so yesterday, foregoing his right to fight extradition from the Bahamas to the United States. Now, that in turn triggered a hearing that is now scheduled to take place in Bahamas court in Nassau at 11 a.m. Eastern time. That would be to formalize this accord. Now, if the judge okays this deal, the FBI would then be expected to escort Bankman-Fried to the U.S. as soon as today. And then by tomorrow, we would expect that Bankman-Fried would appear in the Southern District of New York, where he's facing charges for an arraignment, where he'd be expected to enter a plea of guilty or not guilty, and he'd also get a bail hearing, and that's up to the judge. The judge decides whether or not he can be free pending his case's conclusion. Now, the New York Times is reporting that Bankman-Fried's lawyers are already working with prosecutors on a bail deal that would include strict monitoring. But again, that's just up to the judge in the very end. One of the main arguments against bail would be the same that led Bahamian authorities to deny Bankman-Fried bail in the Bahamas, saying that because of his vast financial resources, of course, which he has said he does not any longer have, that he would be a flight risk. But it also raises the issue anytime you have a very wealthy defendant facing criminal charges and going up for a bail hearing, that there is some tinge of unfairness, because a lot of times these hearings and the bonds that can be expected, multi-million-dollar bonds in many cases of these large financial frauds, they can be deemed unfair and favoring the wealthy over those that can't afford to put up these types of assets, whether that's cash or otherwise, in order to keep themselves free. So a lot to watch today, and we'll certainly be watching for this hearing that begins shortly in about a half an hour.
Who has been deemed a flight risk, and for such a large a case as this, what typically is there in terms of pass-through of information from one jurisdiction to another? Because it is the Bahamian authorities that also had to kind of sign off to make sure that this was happening as well.
Right, and they haven't signed off yet. The Bahamas judge does have to formalize this deal, but there is an extradition agreement, a treaty between the United States and the Bahamas, whereby the two countries agree that they will work together to make criminal defendants come before whichever jurisdiction is prosecuting them back and forth. So we would expect there to be cooperation between the two. But look, yesterday's hearing brought a lot of confusion. It was described as chaotic, where the Bahamas attorney who's representing Bankman-Fried said that he had not been given information that had been discussed with his U.S. lawyers. So definitely there is a little bit of discord there, but we'll have to watch at 11 a.m. to see what all transpires and if Bankman-Fried indeed makes it back to the U.S. sometime in the next 24 hours.
Yahoo Finance's own Alexis Keenan continuing to track this proceeding, this case more broadly. Thanks so much, Alexis. Appreciate it. Coming up in a gruesome year for tech, which stocks have withstood the headwinds, or at least compared to the rest of them? Yahoo Finance's Dan Halley is going to break that down next. It's been a rough year for tech, to say the least. And while it's been a sea of pain across the board for the sector, we are taking a look at the tech names in 2022 that have done better than its competitors, making it the best-ish performers of the year. With all the details here now, we've got Yahoo Finance's Dan Halley. Dan?
That's right, Brad. Yeah, not a great year for tech by any stretch of the imagination. Not a good year for the S&P 500 at all. But there are some companies that managed to do, as you said, better than others. They're, bad and then the worst. So these are the best-ish kind of companies. We obviously have Apple, Microsoft, and Qualcomm. Let's start off with Apple, which year to date, as of the close on the 20th, had a whopping negative 25.49% on its stock price. And so not great. This isn't something you would normally have as a best of the year. But still, as far as the tech basket that we looked at goes, this was the top performer. And if you want to talk about why Apple did well, its Q1 had record revenue. It continued to do well throughout the year, posting record quarters for each subsequent quarter on the power of the iPhone sales. We know that towards the end of the year, there were those disruptions as far as protests at the plant over in China where they make the iPhone Pro, the iPhone 14 Pro. That caused some slowdowns in the ability for iPhones to get into consumers' hands. And then we had heard that Apple was also telling its manufacturers to slow down the production of the iPhone 14 Plus just because people simply weren't that interested in it. So it's been rough going for Apple as it has been the rest of the sector. But as far as the basket that we looked at, it could have been a lot worse. After Apple, we also have Microsoft, another obviously big stalwart in the tech space. They continue to do well as far as their cloud offerings go, the Azure platform being the main standout there. But the problem was that they started to see year over year growth slow as far as that all-important business goes. They still managed to do very well. We obviously had the cloud up 20% year over year in Q1 fiscal 2023. That's their most recent quarter. Their calendar is all sorts of mixed up. So they aren't doing exactly bad, but they did manage to beat out the likes of Amazon and Google as far as the cloud business goes. And so they're one of our best-ish. And then finally, surprisingly, a chip company, we have Qualcomm. While Intel, AMD, NVIDIA were all basically dogs for the year, Qualcomm managed to do relatively well. And the reason for that has to do with a number of things, chief among them the fact that they're trying to diversify outside of relying so heavily on the handset space. So they're getting into servers, they're getting into PCs, they're getting into automotive. And they've been doing this for some time, but they seem to be stepping it up a lot more. The other thing had to do with the fact that their 5G chips are going to continue to be in Apple's iPhones. They originally were only expecting to provide roughly 20% of the chips for iPhones next year. Now they're going to be somewhere around 100%, and that has to do with the fact that Apple simply hasn't been able to get the technology to where they want it to be. Qualcomm's already got it, so why not just go ahead and continue to use theirs? So for the year, these are the three, I mean, it's just laughable, best-ish tech stocks that we've managed to pull together. We'll have the worst tomorrow, and my God, those are bad.
I don't know. I'm bracing myself for that.
They're rough.
Yeah, I mean, I'm looking at the Philadelphia Semiconductor Index, and every single component in there was down on the year. How are these company executives, how are analysts, how are investors feeling after this year that they've had?
It's interesting. It's because, we obviously have talked about these trends that we've seen where PC sales down, smartphone sales, people are starting to pull back a little bit. The big spenders, the businesses, they're starting to pull back a little bit just because of inflationary pressures. The idea that, maybe we're going into recession, that seems to change that narrative every day. But that seems to be the big issue for a lot of these companies. That and, we had the huge problems with supply during the pandemic era. Now there's just too much inventory because people aren't buying enough of them. They already put all these products out there. So they're trying to get rid of all that extra channel inventory. So that's really the main discussion that we're seeing overall. But I think, going forward, they're a lot more upbeat than you otherwise might think, considering the numbers that we're seeing.
Yeah, I wouldn't expect very much upbeatness at all, given those returns. Thanks so much, Dan Howley. Appreciate it. Well, coming up, lawmakers have unveiled a new $1.65 trillion spending bill. We're going to break down the latest in D.C. with Stifel's Brian Gardner. That's next. After several delays, Congress unveiled its over 4,000-page, $12 billion spending plan for the upcoming fiscal year. The $1.65 trillion omnibus bill includes increases in military and domestic spending, as well as major policy changes. Joining us now to weigh in is Stifel's chief Washington policy strategist, Brian Gartner. Brian, good to see you. Thanks for being here. When it comes to what could be most important to markets, to business going into 2023, what would you key in on this bill?
So broadly speaking, I would key in on certainty, that the fact that this is getting done, it's going to pass, and it's taking a risk off the table for next year. Then at kind of the next step down on certainty, it's at being able to plan. So defense contractors can plan because the defense budget has been approved, and we're going to get an increase in defense spending. Infrastructure projects go forward at higher levels because the budget's been approved. So there's a certainty of what government spending is going to be next year, and for contractors and firms that interact with the federal government, that's a significant thing. Again, taking the risk of a government shutdown off the table at the high level, that's a big deal.
There's still some matters within this that could cause hang-up within Capitol Hill. So what happens if this doesn't pass?
So with the premise that I'm now highly confident it is going to pass, more confident than I was 2 days ago. If it doesn't, then Congress would have to switch gears really quickly, pass another 1 week short-term spending bill, come back next week, and figure out what's next. And they would have two options. One, pass what's called a continuing resolution for the entire year. So government would stay open, but there would be no increases for defense or anything else. So you operate at the same levels. The other option, which I think is less palatable to some, is that you pass a further short-term spending bill into February, maybe March, let the House Republicans figure out what they want to do and put their imprint on the spending bill for the rest of the year. That has a lot of risk to it, to markets, for a government shutdown, because I'm very skeptical that House Republicans are unified enough to pass a spending bill next year. And so the risk of a government shutdown under that last scenario go up.
Brian, within the new bill, it was supposed to be that easier for retirement. There's some new changes coming in there. Can you walk that through us, and what does it mean to the average saver out there?
So the Secure Act 2.0 changes some of the rules, makes it easier for retirement savings. So there are going to be deferrals, delayed deferrals with mandatory withdrawals. So once you get to 72, you don't have to withdraw anymore. You can wait to 75. That, as we're living longer, that's a bonus. There are the ability to automatically enroll employees and kind of force them to save. And as Social Security is in more of a question going forward, you're going to have another level of savings. And the other is letting small businesses kind of collaborate to form their own savings plans and 401ks, which is something that's held back small businesses. It's just very technical, very cumbersome. This kind of makes it easier for smaller businesses and workers at smaller businesses to save for their retirement. So the amount of assets that brokerage firms will have at their disposal, be able to attract, are going to go up, and it's a positive for the industry. But I think it's a positive for savers overall, because it gives them more options to save for their retirement.
Brian, I want to ask you about another aspect of the bill that didn't make it in, and that's safe banking. That was the legislation aimed at making it easier for the cannabis business to do banking in the United States. So as I say, it didn't make it in there. What are the prospects for that going into 2023? I mean, the stocks have been all over the map, sort of following the prospects for that part of the bill.
So they definitely diminish next year compared to this year, but it's not, the bill's not dead. Some of the prime sponsors of the bill in the House, Ed Perlmutter from Colorado, is retiring. House Republicans will not prioritize this the same way Democrats did, but there is bipartisan support for it. It's not going to go away, but just not going to have that primary driver in the House to move the bill forward. I think there has been some reaching of minds in the Senate about what a compromise bill should look like. So in some ways, there were steps forward for the bill that could make it easier down the road. But again, it's just not going to be a priority in the House. even though it actually did take a few steps forward in the Senate. So on the whole, I think the odds of it passing in 2023 are lower. But again, the bill's not dead. It's just not going to get a boost that it has had the last 2 years.
Looking forward to 2023, what do you believe will get done in Congress, given that we do have a changing of the guards, given that now you still have a pre-election year that's going to be taking place in 2023, where some politicians might be a little bit more adamant about signaling where they're going to take action on decisive matters. But is there anything that investors, the street, should be paying close attention to actually getting through next year?
So I'm going to take that from a little bit different an angle.
Sure.
First of all, you have to pay attention to the debt ceiling standoff, and that's not so much of what, will get done, won't get done. It will get done, but there's going to be a lot of drama around that, which could lead to market volatility. That is also a potential vehicle for other items to get passed, maybe on immigration, which is important not only just for the border, but for the business community, for certainty for higher skilled workers. And I'm not predicting that's going to happen, but this is kind of an avenue where lawmakers can look to pass something that has really had a lot of difficulty passing. Given the FTX blow up of the last couple of weeks, crypto is certainly rising on the priority list. And so I do think there is a kind of consensus that something needs to be done. There's no consensus yet on what needs to be done, but definitely there's going to be some action on cryptocurrency in 2023 into 2024 to give that kind of regulatory certainty around different products. It may be a broad bill covering all digital assets. It may be more tailored, just looking at stable coins. But I do think that the political will to do something is rising.
It sure seems that way. All right, Stifel Chief Washington Policy Strategist Brian Garner, always good to see you. Happy holidays to you and your family. All right, straight ahead, Morningstar CEO offers up a dose of wisdom to those trading meme stocks. We'll be right back with that check. Morningstar CEO Kunal Kapoor has a dose of wisdom to share with those still trading meme stocks. I had a chance to talk with Kapoor on that topic and his outlook for next year.
there's just no doubt that there is a change in who's investing and how they're investing and what they're investing in. And I think that that's a really good thing. People are getting engaged with their money much earlier than their parents' generation. You sort of said that maybe the excitement has petered out a little bit. I'm okay with some of the excitement petering out. What I think is critical, though, is that people stay engaged with their money, because you want to start ensuring that when people think about their money, they're also thinking about the long-term outcomes that they're hoping to get to.
Is there any data, I know you guys will talk about your treasure trove of data at Morningstar, but is there any data that you see that these meme stock investors, that these new investors to the market in 2020, 2021, you name it, that they are now long-term investors, that they're finally starting to take the lessons they have learned over the past 2 years and applying more principles, let's say like economic moat, which I know you're familiar with it over at Morningstar?
Yeah. I don't know, maybe it's a little bit early to say that they have kind of transitioned fully into being long-term investors, but here's how I'd answer it. When you look at data on Morningstar.com, you find a lot of people who are looking at meme stocks, also doing things such as looking at index funds, looking at index ETFs. And so you sort of see that there's an interest there that exists as well. So my hope is that even as maybe people have been using some of their fun money, so to speak, to do some of the meme stock investing or maybe investing in crypto or what have you, that the serious part of their investing is really starting to transition to things that, over time help them build wealth.
Do you sense that excitement may come back into the market next year amongst this crowd of investors?
Well, it may come back in different ways, right? Let's think about investing. You and I are, thinking about the markets all the time. And so I think we maybe make the mistake of assuming that everyone we know loves the markets and is as engaged in the markets.
Wait, they don't? I thought they did.
Oh, I thought they did. That's the news flag, right? And so what you really want is that people find ways to stay engaged. And I think what's happening with younger investors is they're finding other ways that they're going to stay engaged. And so I know one of the topics on your mind is ESG. And regardless of what you think about ESG, the most important thing to take away about it is it allows for personalization and personal choices to become part of your investment process. And so if you think about what's happened with investing, as you've sort of seen in the past 2 decades, maybe some of the fun of it has gone out. And maybe what you were hearing from investors with the meme stock craze is they want some fun back in it. And I think what that really means is they want some personalization and some relatability. And so for Main Street to really get involved in it, I think you want to continue to sort of see trends around personalization take hold. And that's why I'm more optimistic than ever before.
Well, just given this whole influx of new investors to the world of investing, how do you position Morningstar to capitalize on it?
Yeah, well, we do it in many ways. But most importantly, when I think back to when I first became an investor, when I was in college and thinking about it, I really was faced with just a couple of choices. Do I want to invest in stocks? Do I want to invest in bonds? Or do I want to have my money in cash? Today, investors have all kinds of new and different vehicles through which they can invest, as well as emerging asset classes such as private equity. And then they have ways that they can personalize how they go about investing, such as through ESG, for example. And so for Morningstar, our mission is always to empower investors. And the way we've thought about it is that as the investor portfolio evolves, so too does Morningstar need to. And so you may be surprised to know, but we own PitchBook, which is our largest single product today, and it's focused on the private and venture cap markets. We've made a lot of investments on the personalization side. We offer direct indexing. And so these kinds of things really go to the heart of both the evolving investor portfolio, the need for engagement at the investor level, as well as the use of technology to really impact that engagement that you have with the investor.
Yeah, no, I absolutely want to get into PitchBook. It's a service that I know and I've used for quite some time. Just going back to just investing, as a standalone thing. I go to your annual report and right at the top, you're talking about economic moat and Warren Buffett. Does that type of value investing, does that still work in a market moving as fast as it is nowadays?
Yeah, I think it does. And history has shown that when a lot of people say it doesn't is exactly when you want to kind of go back to it. I mean, the concept is really simple, right? That you want to invest in companies at the right price that have sustainable moats, as we call them, which is essentially inbuilt long-term competitive advantages. So for example, a company might have network effects. That's a concept you see a lot with a number of technology companies that are large caps, right? And so we think those are sustainable ways that companies compete. And if you can get those at the right price and hold these companies, for lengthy periods, your capital tends to compound because they're great businesses and they do a good job with capital allocation. And a buy and hold strategy does tend to work pretty well over time.
For those not familiar with Morningstar, have you pivoted or ventured into the crypto space at all?
We have not. Certainly, we provide commentary and research at a high level about what we, think about the crypto markets, and we certainly have the data available, but we've not made any meaningful investments in the space.
Is everything that has happened lately with crypto, FTX, Voyager, you name it, does it make you take a step back and think, well, we may never get into this space?
I think you want to always be open and thoughtful about it. And the reality is when things go wrong in a space, it's probably, worth actually looking at it a little bit more closely. I would say that there was so much euphoria that had you stepped into the space a year and a half ago, I'm not sure there was much value to be added other than to kind of warn people, which we did, that, when things look so euphoric, something has to be amiss. But we're keen to spend some time, in the space and think about what are the practical implications. And, to the extent that they are, I think we will, provide some research on it and, also, provide investors with ways to think about building it as part of their portfolio. Today, I think we'd sort of really recommend that it sort of stays in the fund money part of your portfolio, so de minimis amount, and may be used as a learning vehicle, but we certainly have not gotten comfortable where we think it's a full-on asset class.
That was Morningstar CEO Kunal Kapoor. All right, let's do a quick check of the markets here. Gains have accelerated since the opening bell on Wall Street, notably on the Dow. You're seeing the Dow now up more than 510 points. Gains being supported by a big move higher in Nike, which is having its best day in 1.5 years. That's on the back of a solid quarter last night. Nike is the top trending ticker on the Yahoo Finance platform right now. Coming up, a billionaire new owner for the Phoenix Suns. We'll discuss next.
music. Time for Cup of Time. 3 stories, 1 minute each. We start with this today. Mortgage executive Matt Ishbia is finalizing the purchase of the NBA's Phoenix Suns and the WNBA's Phoenix Mercury from owner Robert Sarver for $4 billion here. Now, you remember that, of course, under Sarver, it became clear that there were, and after some allegations, it became clear that there were issues of a toxic workplace culture, racism, misogyny. The NBA suspended him for a year, fined him $10 million, and then that really ensued some of the sale activity. But for Phoenix, I think this is perhaps a very energetic new owner who we've had on before today.
Yes, longtime friend of the show. If there's anybody that can be the CEO of a mortgage giant and also run the Phoenix Suns, it's Matt Ishbia, probably one of the most energetic CEOs I've ever talked to in my entire life. But also, too, I think this could be him just diversifying his portfolio a little bit, his own wealth, because it has not been a good year.
I was going to say, he needs some diversification. UWM has not done well.
It's been a challenging year for them as rates have risen. It's been a challenging year for its rival rocket companies as well. So him, maybe a little diversification. He's also won a title as a member of the Michigan State team under Tom Izzo in 2000. So
wow.
He's literally obsessed with basketball. Sure seems like the right fit to me.
I think we've got buzz, but just one more observation. It is interesting, given Sarver's difficulties, that they didn't choose a diverse owner for this team. All right, sorry.
General Motors on some rocky road. The automotive manufacturer is recalling nearly 140,000 Chevrolet Bolt electric cars in the U.S. and Canada due to a seatbelt issue that can cause fires, and apparently the rug can catch on fire. Just the latest in a long list of issues, but really, it's really just an ugly car to begin with.
There was another fire issue, remember, regarding the battery that triggered an earlier recall. So now there's a fire from a different source. Yes, indeed, that the seatbelt can somehow have some sort of exhaust that can catch fire to the rug in the back.
My goodness.
I don't really know. But.
Yeah, the previous recall was the battery pack and the electric propulsion. This particular recall is going to affect about 119,000 vehicles in the U.S. and about 20,000 vehicles in Canada as well.
Not only you have to worry about looking bad, you have to worry about going up in flames. So it's just not a fan.
Well, obviously, if the people are buying it, they don't think that they
maybe they should. They should
look
go
bad.
Yahoo search.
I mean, what's interesting though, we keep talking about competition in the electric vehicle industry, and obviously this car is not really in the same price bracket as something like a Tesla, for example, but still not great. The now bankrupt Cineworld Group takes a blow as AMC terminates talks of acquiring some of Cineworld's theaters. This had been bandied about for quite a while, that AMC might take an interest in Cineworld to further have economies of scale, but it sounds like it's not happening anymore.
Yeah, and this is actually some inclination that we had gotten from our conversation with AMC CEO Adam Aron, who had said that, look, we're going to be looking for some of the other locations that are fluttering right now at bargain basement prices. And so the investors, the street certainly paid attention to that. And it's clear that AMC was on the offense at this point in time, but you wonder what has really taken place in the environment.
Change of course. I think you wrote that story up. There was
just
huge reader interest on Yahoo.com for that story, Brad, which I think goes to show there's an appetite, I think, for consumers to come, for an AMC to come in there and run a better theater, but just doesn't appear to be happening.
And different ways that they would run it too, like the Zoom theaters that they're talking about, kind of repositioning some of those venues for too.
All right, well, I'm going to buzz us because we're out of time. Let's take a final look at the markets here because we are seeing a pretty significant rally take hold here. All three major averages up by at least 1.5%. And coming up in the next hour, Kiko Fujita and Rochelle Akufo will continue to track this market rally, including a conversation with Wells Fargo's Anna Han. You don't want to miss that. It's next.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo along with Akiko Fujita, and here's a look at what we're watching today. From swoon to swoosh, Nike gives the market something to shout about, but the likes of FedEx slashing costs on recession fears. How much pain is in store for corporate America? We get into that with Wells Fargo's Anna Han. And stealing a march, while Elon Musk is busy building Twitter 2.0, can rivals like Mastodon grab some market share? That platform's user base jumping almost tenfold since his buyout. We ask an expert what the future holds. And 300 days on, Ukrainian President Volodymyr Zelensky will visit Washington today in his first known foreign trip since the invasion. He'll meet with President Biden and address Congress. But first, let's take a look at the major indices. We see all three in positive territory. See the Dow, they're up more than 550 points. Session highs for the S&P and the Nasdaq right now. The S&P up 1.6%, the Nasdaq up almost 1.8%. Let's also check in on what we're seeing with the action in the Treasury market as well. We're also seeing the opposite story here. As you can see, all three of those in the red there, the 5 at 3.75, the 10-year at 3.65, the 30-year at 3.72.
Well, Rochelle, we are starting with the top headline at this hour. Sam Bankman-Fried could be transferred into U.S. custody after today's expected courtroom hearing in the Bahamas. Kicking off at this hour, the FTX founder faces criminal charges connected to the collapse of the crypto exchange. Bring in Yahoo Finance legal correspondent Alexis Keenan, who is following the details for us. Alexis, what's the very latest?
Hi, Akiko. So Bloomberg and Reuters both reporting that Bankman-Fried yesterday signed surrender documentation that would forego his right to fight extradition from the Bahamas to the U.S. And that in turn triggers a hearing that is supposed to be getting underway right about now in a Bahamas court, where Bankman-Fried would be asked to formalize that request. Now, if the judge says that's okay, the FBI would then be expected to be escorting Bankman-Fried back to the U.S. as soon as today. And then by at least tomorrow, we would expect to see Bankman-Fried appear in the Southern District of New York in a federal court for an arraignment where he would be asked to enter eventually a plea of guilty or not guilty. And also he would be getting a bail hearing. Now, the New York Times, they're reporting that Bankman-Fried's lawyers have already been working with federal prosecutors on a bail deal that would include some strict monitoring of Bankman-Fried, like where he can go, where his location, like how far he can travel outside of his home base if he is given the right to remain out of prison. But that decision, ultimately, it's not up to prosecutors. It is up to the judge. And the judge that will be deciding that matter will either be a magistrate judge in the Southern District or the judge who's already been assigned to handle the case, and her name is Ronnie Abrams. Now, the main argument that prosecutors would make against giving bail would be some of the same we would expect that the Bahamas prosecutors and ultimately the judge decided to deny Bankman-Fried bail in the Bahamas, saying that his vast financial resources made him a flight risk. Now, normally white-collar defendants are offered a chance to remain out of prison pending the outcome of their case. But it is not necessarily required. So this will be up to the judge, and the judge will also be considering things like whether Bankman-Fried is a danger to his community. In this case, and with other white-collar financial fraud defendants, that's usually a no. But she's also going to have to, or the magistrate judge will have to contend with issues of fairness, because oftentimes it's only the wealthy defendants who can afford to put up these large bond amounts.
So then as we look at things like fairness, then how was the bond set for defendants in some of these other high-profile fraud cases?
Yeah, so there's a few white-collar defendants accused of financial fraud that come to mind. A lot of people are talking about Ponzi scheme convict, the late Bernie Madoff. He was granted originally a $10 million bond on claims of $50 billion in financial fraud. Ultimately, Madoff didn't meet those conditions, but the judge granted him a reprieve of sorts and allowed him to have restricted travel and a curfew. Also, Nikola founder Trevor Milton, he was given $100 million bond to stay out of prison. That's a huge one. And also, we covered so much Theranos founder Elizabeth Holmes, who was convicted of fraud this year. And in January, she was given a $500,000 bond. So this does happen, but I would expect that Bankman-Fried, if he is offered to stay out of prison, that we can expect that number to be probably very high.
Yeah, a lot of money on the table there. Alexis Keenan, I appreciate you tracking the very latest for us. Rochelle, there's a number of headlines we're continuing to track, obviously, in the crypto space as we keep an eye on Sam Bankman-Fried and his extradition, or what is expected to be his extradition to the U.S. We got this news today that Core Scientific, which is one of the largest Bitcoin miners, have filed for bankruptcy. This is a company that was valued at $3 billion as recently as April. And so not necessarily tying it directly to FTX, but as we've seen some of those crypto assets fall, we've seen other dominoes fall as well. And then on the legal side of things, we've seen those who have been holding money within the FTX exchanges, a lawyer representing some of those clients now arguing that they should be held, or they should be defined as custody assets, which means they should get the payout directly and much quicker, as opposed to that getting swept up alongside the rest of the bankruptcy proceeding. So a number of threads here we continue to track in the space, even as we keep a close watch on Sam Bankman-Fried and his very latest move over in the Bahamas.
And you're right. I mean, it really does speak to this issue of how much contagion will there be? How much of this was sort of underlying issues within the crypto industry versus some of these concerns? Obviously, people panicking, not knowing where to put their crypto, where to store it. So, in panicking, sort of pulling out of some of these things. And then you're just left with the last man standing, which is Binance. Binance with its own connections to FTX as well, wondering, will that be next? Or were they the ones who perhaps highlighted most of the issues that led to FTX's downfall? But in terms of even SBF coming for extradition, there was a lot of back and forth as to whether he would even agree to do it. So it'll be interesting to see what perhaps the thought process was in him deciding to go ahead and have the extradition hearing and decide to come. And also what will await him when he does come here. We know that a number of government agencies have their eye on him for some of these fraud and criminal charges, and all of them trying to get a bite at the same apple. So obviously this is something that will take a long time to sort of unwind. And even when it comes to things like figuring out how much bond, we're still not exactly sure where all his wealth is to be able to determine what kind of bond, would be appropriate. So obviously lawmakers have a lot on their hands for sure.
Yeah, no question about that. Go ahead.
Well, we're gonna shift gears and take a look at what we're seeing with the broader markets. Obviously, a lot for everyone to unpack here. We're going to take a look at what might be in store for 2023. Now, forecasts see pressure ahead as companies face growing recession risks. But what role could the US dollar play in all of this? I mean, we know that as we saw the yields rise, we saw a lot of people going into the US dollar for safety, wondering what would happen with recession fears. And that's obviously affecting a lot of companies, multinational companies with exposure in overseas markets, Akiko.
Yeah, although we have seen the dollar index come down since the end of November, about 8% right now. And that's kind of been the story here. When you think about what's been playing out among corporates in 2022, it really has been about the strength of the dollar. Now, we've got some companies who are especially exposed to all of this: Nike, IBM, P&G, Hasbro, Caterpillar, Qualcomm. I mean, basically any company that has a significant exposure outside of the U.S. The stronger dollar obviously makes those foreign revenue less valuable when they bring it back into the U.S. So, you could argue that as we've seen the dollar weakening, that would potentially be good news for some of these corporate earnings. Now, having said that, it's the reason behind the weakening of the dollar that's raised questions about where things could go going into next year. I want to point out a note from Wells Fargo saying they expect a rally in Q1 before things start to weaken. And they've talked about the dollar falling as much as 10%. A lot of that has to do with where the Fed's likely to move, even though the rate hikes are likely to slow down. That's partly because of the recessionary concerns. That is likely to pull back on the dollar even further. And right now we're looking at 104.11. Again, worth noting that at the end of November, we're looking at roughly somewhere around 114.
I mean, and when we look at some of these predictions for where we could see the S&P going, we know that Morgan Stanley's chief equity strategist, Mike Wilson, he sees the S&P falling as much as 21% in Q1, recovering, though, to about 3,900 by the end of 2023. We saw similar bearishness also from Bank of America as well. They're also expecting that the earnings outlook will deteriorate next year. And a lot of this, the turning point, and what they're considering, which might push equities back up, is whether or not the Fed will halt when it comes to these Fed rate hikes. So a lot of big ifs, because there's a lot of data that can come out between now and then that we know the Fed is data dependent. So we'll be keeping an eye on that. Right, let's continue the market conversation now with Anna Han, Wells Fargo Securities Equity Strategist. Good to see you, Anna. So in terms of what you're viewing right now, in terms of some of these outlooks that we're seeing, a lot of different estimates as to where we might see the S&P go perhaps next year. What are some of your outlooks?
Well, we're with the consensus in the sense of caution. Everyone on the street right now is being cautious because what we want to see is what does the data say? Like you said, the Fed has been data dependent, and much of last year was macro driven, depending on monetary policy tightening pace, depending on what yields were doing, and depending on what inflation expectations are doing. That's really what was shaking equities back and forth, particularly because some of the large cap indices that we track in the US are more growth exposed. They're more growth oriented, more tech heavy, and they tend to be having that duration risk. So for our outlook for next year, we too are pretty cautious going into the beginning of the year. We think yields could actually go back up the 10-year closer to 4%, weighing on equities. But as we get maybe some relief from the Fed stopping in the back half of next year, that could help that recovery that a lot of people are hoping for.
Yeah, what is the expectation on your end in terms of whether the dollar is likely to move? I mean, do you buy this argument that we're likely to see one last rally before we start to see a pullback on some of those recessionary concerns?
We would agree generally with that, Akiko. When you think about what the dollar really is driven off, it's yields. But what we have to be careful here is yields are broken into those two components. You have the inflation expectation or break evens, and then you have real yields. Right now, that inflation expectation has come down pretty aggressively as we've seen a bit more of a downward trend in CPI prints. But yet, we don't think the Fed is going to be that quick to pivot from a slowing and tightening to a full easing or a cutting. And that pause as well needs to get repriced. So we are likely to see, in our view, that yields go up a bit higher in the beginning of the year before they really start to fade again towards the back end of the year, driving the dollar weaker more towards in the second half.
And Anna, how do you think investors are pricing this in at the moment, if at all?
Well, I think what they're thinking about right now, the focus is shifting from a little away from the yield story, still very important, but is how is this going to impact corporate earnings? In the end, the reason why we think about the dollar is it's sort of telling us what are corporates and companies here who have international exposure going to be at risk for? And the main driver I think investors are betting on is the consumer. The consumer is looking to weaken a bit next year because they've drawn down a lot of that excess savings, drawn down some of their savings rate, but they continue to spend. But as they shift that spending and decide to really trade off between durable goods and more experiences, World Cup, Super Bowl, holiday travel, these are kind of things that if people continue to spend on, we might see less of an earnings contraction and still some hope for corporate growth in certain parts.
So Anna, with that said, I mean, what does your portfolio look like going into 2023? Are we going to continue to see some of those sectors that really dominated this year, like energy, lead the way? Or could we potentially have some sectors that are being overlooked right now?
I think you have both there, Kiko. I think energy, though, is going to be more dependent on really the global situation with Europe's energy crisis, how they handle the winter and prepare for next year's summer. But when you look at other parts of the market, for example, we talked about yields impacts on growthier sectors. We're looking again carefully at tech. Tech's had a tough run this year, but places that might have a turnaround, and we're getting a little more positive rather, or looking more at software where services could be that service spending helping those kind of parts of the market. In particular, if the consumer doesn't catch frostbite this winter and spends, then we could see some of these more cyclical, but also still more growthy aspects of the market come back. That's what we're looking at. And with the chances of the Fed being able to hopefully achieve a less hard landing, I think that raises the chances to step away from the more durable goods, more away from food, beverage, and tobacco. So we've downgraded that sector as well.
Yeah, some good takeaways with just one more week to go here before the new year. Anna Han, Wells Fargo Securities Equity Strategist, appreciate your time today. Well, shares of Rite Aid are hitting a 52-week low today as the company lowered its full-year guidance. Take a look at that stock move, down more than 13%. A drop-off in COVID vaccinations and testing weighed on the drugstore operator, with it posting a net loss of $62 million. Revenue came in above Wall Street expectations, but was still down year on year. The company lowered its outlook for the year in part because of seasonal markdowns. It has now launched a performance acceleration program, saying that that program will improve sales, script volume, and operating margins, and free up cash. And Rochelle, interesting to see sort of the knock-on effects. We've been talking so much about the changes to the vaccination process for COVID, but that now weighing on a name like Rite Aid, down significantly today.
I mean, you know, Rite Aid, a lot of these drugstores, they were really the local community heroes when it came to a place to locally just go get your vaccines. But as we know, people pulling back now on all these boosters, so people aren't going in. There's not as much foot traffic there. And in fact, in the first 9 months of this year, Rite Aid has lost more than $500 million. They've seen revenue relatively flat or falling, along with some of these store closures as well. So as we mentioned, there's some of the things that they're trying to do to either turn things around or perhaps find other ways to bring more customers in or get more revenue streams. I think they're going to need it because a post-pandemic plan was needed. We've seen a lot of pandemic darlings falling, and Rite Aid seems to be in a bit of trouble here as it slashes that full-year guidance.
Yeah. I mean,
Right, well,
certainly. I was going to say that there's a lot of people who are sort of, not pulling back on the booster shots too. So it's not just about sort of the pullback in the cases, but it's not a lot as much foot traffic going into Rite Aid.
No, it's true. It's the nature of, the pandemic, sort of people sort of weaning off and perhaps not being as eager to take even more boosters as they continue to roll out as well. All right, coming up, future leaders. Research from KPMG says Apple could become the fourth biggest EV player in the next decade, but it hasn't even made a car yet. We'll talk Tesla woes and opportunities for a fast developing market next.
Well, let's take a look at where Tesla shares are trading this morning. A slight pop there, a move in the stock's month-long decline as CEO Elon Musk deals with unhappy shareholders and at the same time navigates his path at Twitter. This unrest among Tesla shareholders comes as a new report released by KPMG shows that executives are taking a more cautious view around electric vehicle expectations in the coming years and shows Tesla remaining the market leader in 2030 by a much narrower margin than previously expected. And Rochelle, it's worth pointing out that so much of the Tesla stock move to the downside has been put in the context of Twitter. And you could certainly argue that Musk, because of the cloud or because of his distraction with Twitter, has certainly led to some uneasiness, to say the least, among Tesla shareholders. But there's a lot of other factors that are adding to this as well. One is the increased competition in the EV space. Tesla obviously at a much higher price point when you think about other EV cars that are coming on the market. And you see right there, I mean, they have been far away the leader in this space. But you've got other cars that are coming online that are offering a cheaper alternative. And part of that is the concern whether, in fact, Tesla will be able to maintain its leadership or maintain the kind of leadership they've had over the last few years.
I mean, when you think of where Tesla was, when you think of what was already out there when Tesla first came out, look how crowded the market now is in terms of who's there. And as you mentioned, at a more affordable price point. And we know that Musk cited some of these macroeconomic factors saying, look, the Fed continuing to raise interest rates makes it harder for people to finance cars at a time when inflation is high. And so he's blaming some of those factors. But a lot of people, when he initially bought Twitter, there were those initial concerns. Is it going to end up being a distraction? And as we've seen, it was more than a distraction as he, continued to sell some of his Tesla shares, potentially, we think, perhaps to help prop up Twitter. But it's just one less thing that people needed when they want to really focus on what makes Tesla a great company, the innovation, and not sort of being distracted by a lot of back and forth on Twitter. And so I think obviously a lot of shareholders were disappointed here, and they want some sort of clear path forward about what Musk is going to do next.
Well, and to be fair, Twitter is a big cloud hanging over Tesla. We did finally get a response from Elon Musk there after that initial poll that asked whether, in fact, he should stay as CEO. The vote, of course, was in favor for him leaving as CEO. Since then, he's tweeted saying, I will resign as CEO as soon as I find someone foolish enough to take the job. After that, I will just run the software and servers team. Now, it's worth pointing out that line again. Just run the software and servers team. That's a big chunk of the business still for Twitter. So if the concern among shareholders is about Elon Musk, spending too much time with Twitter, I'm not sure him stepping down as CEO is necessarily going to alleviate some of those concerns when you think about how big that portfolio within Twitter still is. Of course, we don't have a timeline. He hasn't said when. He hasn't said who the CEO is. We don't have a succession plan. Still a lot of questions there. But I don't know if you were jittery about Tesla and its prospects. Seeing this tweet necessarily says, okay, fine, he's going to be all in on Tesla again.
Yeah, it didn't really seem to move the needle because he left it wide open. You have to be foolish enough to take it. And obviously, he has to sign off on this. And we know that of some of the names that were bandied around, when people put them on Twitter, he said, no, I don't see it. So he's really left the door open. So I'm not sure how much hope Tesla investors should really have about when he's going to be stepping down. And he clearly hasn't laid out a timeline as well. All right, coming up, signed, sealed, but not delivering. FedEx vows to slash another $1 billion in costs as fears of a recessionary environment take hold. But some are bullish on the stock. That conversation up next. FedEx shares enjoying gains this morning. That's after the company promised more aggressive cost cuts as declining volumes weigh on margins. We're here to add some perspective on the company is Bank of America Global Research Senior Transportation Analyst Ken Hexter. Thank you for joining us this morning. So I want to get your takeaways because this is another round of billion-dollar cuts on top of what they'd already planned for September. What are your big takeaways from what this really signals for the company?
Great. First of all, Kiko and Rochelle, thank you very much for having me and happy holidays. What the billion-dollar cost cuts really indicates is first, the $1 billion represents about $3 of earnings per share. So they set a target of $13 to $14. That's down from, remember, almost $24 they were targeting before they pulled their targets back in September. So just to put on scale how much things have changed, it tells you that volumes were quickly kind of falling apart, decelerating on an accelerating pace. Or declining at an accelerating pace, and then and it tells you that they're making moves to cut costs very aggressively, right? So they've set now a $3.7 billion target of cost cuts, up from 2.7, adding that extra $1 billion, and that's how they set this $13 to $14 EPS target. But they're making these moves because volumes are coming down so fast. But finally, they're taking steps beyond just keeping pace with the cyclical change. They're talking about the structural changes. And that's really what's key for FedEx. That's what investors are looking for, is kind of some structural changes that will pull real costs out of the business. And that's kind of what they were talking about with that $1 billion of additional costs to really get the enterprise back on track.
The declining volume there, as you point out, is cyclical, not specific to FedEx, but the rate with which it's decelerating, how much of that you think is a FedEx-specific story, and how much worse is that likely to get?
Well, it's a great question. I think last quarter we heard about a lot of, FedEx even commented that UPS and DHL were eating their lunch in Europe as they were just finishing up their integration of the former TNT with FedEx Europe. I think now part of this is really, general economic impacts, particularly out of Asia with China shutting down for as long as it did during the quarter. I think you saw that. We were just out at UPS. They talked about the impact from Asia. So I think that's more broad-based. I think domestically, it's not really about share gains and losses right now. It's really the economic backdrop, as the CEO, Raj Subramaniam, talked about. It's really more about the lack of e-commerce, right? On a comparable basis, where you had it run up as such a huge percentage of retail sales, it now coming down more toward historical or where it was pre-pandemic levels, still a little bit higher. But I think that's really what you're seeing. And that's kind of the core business that had run up. And that's kind of what's pulling back now. But again, FedEx, for the first time in 20 years, gave us monthly statistics on volumes, and you're seeing them decline at an accelerating pace into the end of the quarter. I think that's the key that we should all take away, is things are still ugly and progressing even worse in terms of a volume environment.
And you mentioned, obviously, when it comes to the express business, it was Asia and Europe really being the most drag there. What are your expectations then domestically versus, say, internationally for FedEx?
Well, domestically, we heard the rails talk about parcel volumes on the railroad being down about 15% in terms of, UPS moving from the West Coast to the Midwest. That kind of mirrored what we heard. If you look at what the breakdown of FedEx into their domestic side, you're seeing down mid-teens. So those are pretty strong levels on a domestic parcel level. So when you think about U.S., ground volumes were down 9%. We were looking for down 4%. Freight volumes, that's the kind of LTL, less than truckload portion of their business, also down 9%. So you're seeing close to double-digit declines and accelerating to the downside. So that highlights that backdrop of the e-commerce, as well as kind of just the core economic activity still on the weaker side.
Ken, you mentioned China being a big overhang in terms of demand for FedEx. You've got a lot of bullish calls out there from analysts who are saying the demand is really going to accelerate once China begins to sort of opening up really picks up pace. It's already underway. What's your outlook on that front, and how significant is that demand likely to be come spring, for example?
Well, that's a huge opportunity, but you also just missed a huge opportunity, right? Which is peak shipping season. Peak shipping season is that holiday season, call it from Thanksgiving till Christmas, when you see a lot of retailers making up a large portion of their shipments. We had a very, very muted peak shipping season. And so now you've got to move into the new year, into that. We still have high inventory levels in the system. We do a truck shipper survey every 2 weeks. We just hit the highest level of inventories in our dozen plus years of doing this biweekly survey. So when you think about the high level inventories, we obviously have some stuff to work through in the economic system. And with demand being down, it's just going to take a little bit longer. So as China ramps up, certainly a huge opportunity, one, for the sales overseas, and then within Asia, and then obviously for the transborder shipments that become a big part of the profitability growth driver. We've got to work through some inventory. So as you mentioned, it depends on your time frame through the year. The later you go, obviously, then the more bullish it is into an economic rebound. But we are certainly working through those very high inventory levels over the next few months.
Yeah, a lot of companies betting on that rebound coming out of China. Ken, it's good to have you on today. Bank of America Global Research Senior Transportation Analyst Ken Huckster. Well, coming up, Elon Musk, of course, busy building Twitter 2.0, but can rivals like Mastodon grab market share? That's something we've heard about a lot lately. We're going to ask an expert what the future holds on the other side of the break.
Checking in on the crypto world as prices were volatile this morning. You see it's a slightly mixed picture here, but gaining back some ground here. Now, this is while the price action was continuing to fluctuate. The governor of India's central bank had predicted that crypto will be the reason for the financial meltdown should it not be banned. Now, while speaking at a summit this morning, Governor Shaktikanta Das said, quote, "If you try to regulate it and allow it to grow, please mark my words, the next financial crisis will come from private cryptocurrencies." Some strong words there, Akiko, from the central bank governor there in India.
Yeah, I mean, this coming from a central bank that does not necessarily recognize those private cryptocurrencies. So not entirely a surprise, but it is interesting to see, at least one governor coming out and speaking on this, because what I've been wondering is, as we've seen the collapse of FTX and then some of the contagion effects that have played out in crypto overall, how many of these central banks start to accelerate their use of digital currencies? Obviously, India exploring the digital rupee already. You've got China way ahead on the digital yuan. More than 100 countries are now exploring CBDCs. Does this collapse that we have seen over the last month strengthen the case for that and really strengthen the urgency by which central banks move? I think that's a big question.
I mean, it does give them sort of that I told you so, you sort of bragging rights there when they see these sorts of collapses. Though, as we mentioned there, we have still seen Bitcoin and Ether still doing relatively well considering. But at first, when we first saw the backlash from FTX, they started selling off. It was about losing a lot of trust in the system. And for a system where you have economies as large as India and China, who, they have their doubts about this and they're developing their own digital currencies. This is just one more reason for them to want to steer away from it. And when you think of countries like El Salvador, who had adopted Bitcoin as digital currency there, as digital, as currency there.
Legal tender.
It makes you wonder, thank you. It makes you wonder how much an economy can really have this incorporated into the system when we're still trying to play out all the use cases for crypto and still don't even have it very clearly defined, whether it's an asset or a token or used for currency. So a lot of questions here that I think central banks are still dealing with.
Well, and that's the point that I think the RBI governor was trying to make, is that it's 100% speculative, that there is no use case right now as far as he's concerned. But you're right. I mean, this goes back to that divide we've been talking about that's been playing out globally. There are countries that are on such opposite sides of the spectrum when it comes to what should be done with crypto. India, along with China, one of those who have been very skeptical from the beginning, not an outright ban like we've seen in China in terms of mining as well as the use of crypto, but certainly one of the big skeptics. And so certainly not, a lot of people taking note about what exactly the RBI governor says there on that front. All right, social media app Mastodon has been the main beneficiary of Elon Musk's madness. Can we call it madness? As the Twitter alternative has grown from 300,000 users in October all the way up to 2.5 million users as of November. Joining us now for more on what this means for Musk and the future of social media, let's bring in Karen North, USC Annenberg professor. Karen, we were talking about this yesterday. I have tried to sign up to Mastodon, as has many others, to try and explore. It's not exactly the easiest user interface, but what do you make of this migration that's been happening, and how much do we make of it?
I mean, the migration, I feel like, is much more of a protest than it is an actual, sort of bellwether of the future for Mastodon. Mastodon, as you said, has a very difficult user experience or user, figuring out how to do it. But the other thing is that all of the problems that we see with Twitter are sort of amplified the way that Mastodon has been designed as sort of a decentralized, no central control type of platform.
And for people who haven't tried to take a look at Mastodon, you basically, when you go in there, you have to pick a server that you're going to be on, versus on Twitter, you just sort of jump into the frame, can sort of navigate as you want, and the algorithm shows you different things. Is this an actual viable option at this point for people who are considering leaving Twitter?
At this point, personally, I do not think so. And I'll tell you what the problem is with it that I think people can really understand is that for those of you who have kids who play Minecraft and kids have their own servers, or for those of you who are concerned with or even use Bitcoin and you understand that it's all decentralized and individuals own servers and keep it running, that's how Mastodon works. It's decentralized. So if you want to go in and you want to cover the news in Ukraine, but you accidentally join a server that's all about My Little Pony, then what are you going to do? And when you look at the way that they moderate the content, which is a big concern right now with Twitter, it's moderated, by the people who are on that particular server. So each server is owned by somebody else, and each server has its own code of conduct and its own terms and conditions. So I'm not sure how that works for worldwide news and information.
So, today we're talking about Mastodon. Obviously, a lot of Twitter users moving in that direction. But even before all this, when, for example, former President Trump was banned, it was about, let's everybody who's, on the right move over to Parler. I mean, we have seen a lot of these other alternatives popping up. And I wonder if you think we're kind of at an inflection point when it comes to social media. Are we kind of past the days where everybody united on Twitter to talk about one topic and was able to do that in more of a civil way? Granted, it hasn't been the case in a while. Are we kind of past that when it comes to social media?
So if you want to talk about social media as like social networking and conversations, then, it does seem that we're in a time of the history where it's all echo chambers. People find their own people, their own voices, their own like-minded friends to have their own similar supporting conversations with. But when I look at Twitter, I think Twitter's been misbranded as a social network, and it's really an information and news network where people like you come to Twitter to get a heads up or a headline or a source or a quote for your stories, to build your stories. And it can be from the biggest people in the world, or it can be from people, in the fields, or people on the ground in Ukraine seeing something that we can't see, okay? And they share it, and then you can build your stories. And so the reason that Twitter is different than the others is that Twitter has a worldwide network of not only journalists and information providers, but it also has all of these people from everywhere that are willing to take a picture or write a post and say, hey, there's news here. And so we don't want to decentralize and send people to their own little echo chambers for news. We want something like Twitter where the world can upload information and people like you can then cultivate a story and tell us what we need to know.
And even for the historical value, the number of moments that were broken on Twitter by, people out in the field and really giving us an alert to some of these things that were happening. So then when we take a step back then and think, who are then the most notable runners-up to Twitter? Some people are gravitating towards Tumblr, but who would actually be the most viable option?
If you had trouble working with Mastodon, good luck trying to figure out how to provide news on Tumblr. Tumblr is phenomenal as a sort of digital media visual image gallery and curation system. But I mean, right now, I don't see, there are a bunch of efforts, and they're mostly new, and they've mostly, struggled as people have migrated over. They'll shut down for a day because they get hacked, or they'll shut down for a day because they have trouble with, abusive content, or for a whole variety of reasons. Twitter is as troubled as it is. And by the way, troubled in two ways. Troubled because of just the sort of the way it's built, but also, and troubled financially. It's a platform that's been losing $4 million a day for quite some time before Elon Musk took it over. And then troubled also because of, the sort of speech that is, allowed there at times. But I think the best answer right now is to figure out how to rework Twitter, because Twitter has so many people from so many different walks of life that it allows, like I said, people like you, it allows journalists and other people who have audiences to find stories and tell us, the audience, about the world in ways that really matter. And yeah, you're right, everything from the Arab Spring to the birth of babies.
A very wide-ranging topic on the platform for sure. Karen North, USC Annenberg professor, appreciate you hopping on the show today. Thanks so much for your time. It is now time for today's chart of the day, and we are taking a look at deal-making over the past year. Global M&A activity is down by almost a third compared with last year as companies struggle with a volatile backdrop and economic headwinds. Though this year started out strong with major deals announced, these talks were soon replaced by fears around completion. Sentiment began to fizzle in February when Russia invaded Ukraine, and the following month when the Federal Reserve embarked on its most aggressive rate hike path in years. And you see the drop off there at the very right of the chart there, down at 2022, although still relatively high when you compare it to years past. Well, coming up 300 days on from the start of Russia's war with Ukraine, President Volodymyr Zelensky heads to Washington, D.C. in his first known trip since the start of a brutal campaign that has claimed, by some estimates, 200,000 lives. That's coming up next.
300 days on from the beginning of a brutal war with Russia, Ukrainian President Volodymyr Zelensky will visit Washington today in his first known foreign trip. He'll meet with President Biden and address Congress. Yahoo Finance's Rick Newman has all the details for us. Hey, Rick.
Hey, right. This is a big deal. Zelensky's going to come to Washington, meet with President Biden. He's probably going to be pressing his request for additional weapons that Ukraine says it needs, things like long-range missile systems, maybe fighter jets, more air defenses and things like that. And Biden may not necessarily give it to him. I mean, the White House has been steadfast in support for Ukraine, including military support, but has also been very reluctant to send some of the most effective U.S. weapons. But that could happen in the future. It depends on the way the war goes. So then Zelensky will also address Congress, and I'm sure he will say, you are our most ardent supporter. The United States is the biggest donor nation to Ukraine so far. But I think the White House's hopes that Zelensky's address to Congress will also just generate a little additional momentum for support for Ukraine in Congress. Now, Congress, it looks like they are going to approve another about $45 billion in military and other types of aid as part of this giant spending bill that will probably pass by the end of this week. But there's also the question of whether Republicans who will control the House of Representatives will be as supportive of Ukraine next year as Congress has been this year. There have been some suggestions that maybe they will not be. So I think this is a bit of outreach, probably focused on Republicans to keep the momentum going in terms of support for Ukraine and its military needs in Congress during the next 12 to 24 months.
Yeah, the timing of this certainly worth noting, Rick, and we should expect that 4:30 p.m. Eastern press conference between Volodymyr Zelensky and Joe Biden. It's certainly going to be an interesting one. Thanks so much for that. Well, coming up, shoppers are still racing toward the Nike brand, even as inflationary pressures weigh. We break down the hottest sneakers of the year and a look ahead to next year's lineup on the other side of the break. Well, shoppers are still running toward the Nike brand despite inflationary headwinds and an overall pullback in spending. The retail giant beat on earnings and revenue in its latest quarter as the company saw record growth in its digital membership platform. Let's bring in Yahoo Finance Josh Schaefer, who's been looking at the numbers here. Josh, inventory is still a big concern. That's why we've heard a lot of talk about Nike's markdown, but they've had some success in full price footwear. What's the lineup look like?
Yeah, Kiko. So obviously inventories have been a concern, and that's why we've talked a lot about markdowns and wholesale, and that's sort of what drove that big revenue beat that we've been talking about with the stock up its highest in a year and a half today. But direct sales is also a space where Nike has had a lot of success. So direct sales were $5.4 billion last quarter, up 16%. And direct-to-consumer sales is something that Nike often talks about when we're talking about growth, because that's where they grow in that sneakers app. They have 160 million active members now, and that's where people can log on, they directly interact with Nike, and they buy sneakers there. Now, they singled out a few sneakers in the earnings call. Always fun to kind of take a look at those, right? So CFO Matthew Friend noted that the LeBron 20, the KDs, and the latest Giannis shoe led double-digit growth in basketball. And then all the way on the right there, you can see the Air Jordan 11 Varsity Red, which is an ode to the 01 Cherry Jordans. Those also did very well, and that sort of speaks to Nike's success recently with Jordans. Another thing they mentioned was that Dunks have also outperformed in men's. We talk a decent amount about Nike Dunks here on the program, and that will be one to watch going into next year too, Rochelle, as far as the Pandas, the Nike Dunk Pandas. They just released some mids, and it'll be interesting to see how those sell because we know the Nike Dunk Pandas, the lows, go pretty much instantly on that sneakers app, and then people are trying to buy them on resale at places like StockX.
And of course, we've got the heels of the World Cup. A lot of people like to follow some of the shoes of their favorite stars. What sort of sneakers trends did you see during the World Cup?
Well, Rochelle, a little bit of maybe your rival, right? Mbappe over at France had a great tournament. He won the Golden Boot. And Nike was bragging about it a lot on their earnings call yesterday, perhaps rightfully so. So you can see it right there. It's the Mercurial. And that cleat scored more goals than any other cleat in the World Cup per Nike. They also said the Nike boots dominated the World Cup as a whole and scored more goals than any other brand. And really, I think when you think about what the World Cup meant for Nike, to have those cleats do so well and have Mbappe wearing them, a young star, I do think is a huge win for the brand from a global scale because, of course, we talk about soccer a lot being big here, but maybe not as big as it is obviously worldwide. And for them to have them wearing those cleats rather than, say, Messi, who wears Adidas, and Messi had that Adidas jersey that sold out, it's a win for Nike in the footwear space to have the World Cup's top scorer wearing their cleat. And they took a little bit of a victory lap on it last night, guys.
Yeah, no amount of advertising, right? They can pay for that. I mean, that is just, 90 minutes of exposure per match.
It's exactly what you look for when you get a athlete sponsor, right? It's the same reason why they've sought out people like LeBron for those shoes and people like Giannis, because they're hoping that the championship moment happens with their shoe and their cleat on. And then that's where you get those direct-to-consumer sales at Kiko at full price, because at some point, the inventory problem's going to be solved and the margins, they say, are going to come back in the next 2 quarters. You're going to have to sell full-price shoes, and it looks like there's still demand there with these popular basketball shoes, the soccer cleats, and, of course, everything else Nike has. They have plenty.
Yeah, good point there. They're not short on products. Josh Schaefer, thanks so much for bringing us that report. Let's do a final check of the markets before we let you go. As we said, we were looking at green arrows across the board. Certainly a welcome sign after what we have seen over the last few trading sessions. The Dow is up 500 points, the S&P 500 up 54, and the Nasdaq up 158. That does it for Rochelle and I in the 11 a.m. Eastern hour. We'll be right back here again tomorrow. Thanks so much for watching.